The steady grind, this buy the dip, there's no questioning the price action.
It's certainly a time when you want to really think about your sector exposure.
There's a bit more weakness and rotation and churn happening under the surface.
It feels like a melt-up already.
What we're looking at here is a really, really solid earnings backdrop for the S&P 500 that we think persists in the back half of the year and has legs to run into 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, the president stepping in.
We have a meeting with President Putin. I think it's going to be a good meeting. We're going to see what happens. And I think President Putin will make peace. I think President Zelensky will make peace. We'll see if they can get along. And if they can, it'll be great.
President Trump looking to strike a ceasefire deal between Russia and Ukraine as a more interventionist White House looks for another slice of corporate America. Evidence continues to build that tariffs are beginning to weigh on profit margins. Your stock market just about holding on to record highs.
I'm glad you went there because that was my takeaway from yesterday as well. The idea of profit margin compression. And that's what we saw from PPI that came in harder than expected, particularly with respect to services versus CPI that came in somewhat weaker than expected. Essentially, these aren't getting passed along. This is the backdrop to this geopolitical question of how the United States is going to get involved. It's who's paying for the tariffs. How is this policy making its way through the market so far?
We've taken some heat out of rate cut bets in the past 24 hours. We've seen some pushback too. This from Mike Gapin of Morgan Stanley. If Chairman Powell wants to retain optionality while awaiting August labor and inflation data, he will likely push back against market pricing at Jackson Hole next week.
This is going to be an interesting meeting given the fact that there has been so much political pressure. And you wonder how many Fed chair hopefuls are going to show up to Jackson Hole with their cowboy hats on, looking to make some statement and make some noise about why this is a Fed that could cut rates by some 50 basis points or more. Look, this is the reason why today's retail sales print actually has new import. If you do have ongoing spending by consumers and you have this belief that there isn't really a problem, like we heard from Tom Barkin, in the U.S. economy, then essentially why should the Fed be cutting? Why should the Fed indicate anything of a dovish stint other than just to placate the government, which maybe isn't a great look?
Back to back. All-time highs on the S&P 500. Just about squeezed out a third one in yesterday's session. Futures just about positive this morning. Coming up this morning, this hour, we'll catch up with Peter Chia of Academy Securities ahead of Trump-Putin talks, George Pollack of Signum as the government looks to take a stake in Intel, and Veronica Clark of Citi on why the Fed will cut rates in September. We begin this hour with our top story. President Trump heading to Alaska to meet with Russian President Vladimir Putin. Annmarie joins us now on the ground from Anchorage. Annmarie, a very early good morning.
Good morning, Jonathan. It's a very early morning here in Anchorage, Alaska, as we await President Trump and President Putin's arrival. Now, you're going to hear the term high-stakes meeting all day long, but it is a high-stakes meeting, and that is because at most meetings, when you have a summit of this caliber, leader to leader, months or even years of diplomacy would have happened that led to this moment. But when it comes to Trump and Putin in Anchorage and in this meeting in Alaska, this is really the opener. The president himself said yesterday there is a 25% chance that this meeting is negative, and he is left standing solo at a press conference basically saying this more than 3-year war with Putin's invasion of Ukraine is going to continue. He says this meeting is a feel-out meeting where he can understand what Putin wants, what kind of concessions he is willing to give. His own press secretary saying this is a listening exercise, and the president lowering the bar once again this week, saying that the more important meeting is going to be the second meeting, and that is really the goal of the president when he comes to Alaska today. That is going to be about trying to get Putin to have this willingness to sit down with President Volodymyr Zelensky. The president called it, he didn't love the term, but he said it's not a bad term, divvying up territory. Our reporting is that when European leaders got on a call with the president yesterday, he reassured them that he would not talk about exact territory that either of these two countries could give up. So the best case scenario coming out of this meeting is that there is an agreement in place, maybe a short ceasefire, but an agreement in place for a process to begin to bring this war to an end.
Annmarie, we all know there's a lot of daylight between Putin and Zelensky. How much daylight is there now between Trump and Zelensky? How much has changed since the end of February and that very contentious meeting in the Oval?
I would say a lot has changed, and really one of the most striking images thus far of the Trump administration was, remember when the Pope died and President Trump was sitting one-on-one in the Vatican with President Zelensky. That was really a moment those two individuals broke bread after that disastrous flare-up in the Oval Office. But Zelensky is still not at the table today, and that is something that is very different, strikingly different from the Biden administration, who we should note did not want to deal with Putin directly, but the Biden administration used to say nothing about Ukraine without Ukraine. Zelensky is not here, but Trump continues to play up that it has to be Zelensky and Putin at the table. So he still wants to include them. What I see going on is basically what the president has called in the past. He wants to be a mediator when it comes to this conflict. The Europeans are the one that really take the Ukrainians and Zelensky's issues on board, and they are the ones that are the transmitters of that information to the president, especially with the likes of J.D. Vance having the meetings this year. But I would say that that gap has gotten a lot smaller since that February meeting at the White House.
Anne-Marie, looking forward to your coverage. We'll catch up with AMH in the next hour. Here's the view on Wall Street this morning. Peter Chia of Academy Securities writing this. We see a few competing narratives, all of which have some upside potential with some downside risk. Pete joins us now for more. Pete, good morning.
Yeah, good morning.
Fairly balanced view there. Let's just start on Ukraine and Russia and what you think we can achieve, if anything, this weekend.
You know, I think Anne-Marie really hit the nail on the head that typically two leaders meet once everything's already basically been decided. So this, there's a range of outcomes. There's some possibility they walk away saying they have a deal that Europe can't live with. There's some possibility, I think probably more likely, that Trump, exerts some pressure on Putin. We've started to see a little bit of that, right? We're starting now to find a way to get weapons to Ukraine that are palatable to the Trump administration, right? We sell them to Europe. Europe then passes them on to Ukraine. We're talking about the sanctions. We've threatened India with secondary sanctions. So this could well be a meeting where Putin finally gets the stick, right? It's been a lot of carrot towards Putin. I think that's fairly likely that this comes out maybe very tense, and Trump, for the first time, really puts a lot of pressure on Putin to set up for this next meeting, because I think that's what's going to be necessary. And without a lot of pressure on Putin, he's in no interest to end this war.
What's interesting to me is that all of the analysts we speak to are pretty pessimistic about what can actually get accomplished in this meeting, and yet markets seem to be already pricing in some sort of better outcome, closer to peace. You're seeing oil prices come down. You're seeing European equities to go up. Do you think that it's overly optimistic in terms of how much that base case has already been priced?
Yes and no. I think ultimately everyone kind of sees, whether it's at this meeting, there is a path to peace, right? This war, it's, grinding on. It's hurting both countries. It's the Russian economy's in shambles. The number of Ukrainians dying, the number of Russians dying are both sad. I think Ukraine has more trouble living with that than Russia. I think, Putin's done a very good job from his perspective of, conscripting people from outside of Moscow and St. Petersburg so he doesn't feel the political pressure to end. But we're headed that direction. So I think the market's probably right that unless this turns into some sort of a disaster, if all it does is lead to a next conference, I think that's fine. And I think the market's probably reasonably prepared that we go to that next meeting by getting pressure on Putin. So I think markets are seeing through this particular meeting and looking forward to 2-3 months down the road when maybe there is some sort of deal that's reasonable.
From a domestic perspective, there's the risk that maybe people have gotten overly enthusiastic about rate cuts, given the fact that the economic data hasn't been so bad. I mean, yes, you see non-farm payrolls suggest some sort of downward revisions. We got PPI yesterday that did suggest some tariff impact, at least on producer prices. And then we're expecting retail sales. How much do you see that as a risk event for markets?
I think the economy is slower than people think. I think all those job revisions, we're finally starting to realize, hey, this economy is slower. We're seeing AI, I think, disrupt some hiring. We're seeing pockets of inflation. I've been particularly focused on electricity inflation. You're seeing that kind of rise. The cost of electricity is becoming an issue. I think it's something we're all going to be talking about next year, if not, sooner. So I feel there's pressure on the consumer. I think the global economy is slowing, right? Everyone's trying to figure out what to do with tariffs. And, we're all trying to look for these signs of tariffs. I think we're still in the early first inning on tariffs, right? We've only just seen them come in place. Suppliers are now just talking to their importers and exporters are trying to figure out who's bearing the cost. It's going to take months, if not quarters, maybe a full year before the impacts are fully felt. But I think you're starting to see those signs. I think global economy is slowing. So I think the markets are a little bit potentially in danger of getting too comfortable that we get rate cuts for good reasons, right? If we get rate cuts as the economy is slowing, which I think is happening, and the Fed has to do it stubbornly because inflation won't really come down, I think we have some issues there, and I think we could pull back from markets.
Messaging, Jackson Hole. Is it too early to send some firm conclusions about what the chairman thinks is happening?
I think the chairman's going to, try and send some firm conclusions. One thing that I like about this administration, right, they've picked 10, 15 candidates, right? So they have all sorts of very intelligent people, respected, all walks of life, all saying rate cuts. So you're not, if it's kind of interesting. If he just already named one person as the potential chair, that's all we'd be listening is, what are you going to do? Now we're listening to this whole slew of people. And I think we should have cut in July. And certainly, had we known the June numbers, we maybe should have. So I think we're going to get those. I still think 3, maybe even 4 cuts this year. Certainly 2 for sure are coming. And it's going to be because the economy's slowing just enough.
You mentioned the process. The optics of the process are credible. Is the process credible? There is a difference.
You know, I don't pay enough attention to what this is all going to look like, how it's going to wind its way through the system. I think we are definitely going to have a Fed that works more closely with the Treasury Department and, AKA than the administration. They are going to be more thoughtful, I think, on things like that. And some of it would make sense. I think we should figure out, what's the Fed buying? What does the Fed have on the balance sheet? Where are we trying to issue? There could be a lot more coordination. I think there could be things done. There are things that make me nervous about that as well. Like, you do not want policies set, and my concern will be that we do get these cuts and the 10-year doesn't respond, or the 30-year in particular, because there is a bigger risk premium, right? The risk premium starts getting built in is, what is our data like? Is our data accurate or not? Where do we fit in on our data? Is the Fed going to respond in a traditional banking sense, or are they going to be too conservative? So I think that bears the brunt of it. So if you see 30 years stay stubborn, what is the new Fed chair going to do about that? Are they going to implement some sort of Operation Twist? I think there's opportunities. And I just want to circle back when we talk about the economy and tariffs. That I'm a little bit concerned on. The bright side to me, and I think what's going to propel the economy forward potentially, is kind of this, what we're calling PROSEC, or production for security, where the Trump administration really focuses on national production for national security. We saw the deal with MP. Now Intel's, in the news about that sort of potential. I see this as really right up the president's alley, right? We're going to support biopharma, pharma, biotech, chips, rare earths, and critical minerals, and we're going to do it through investment and deregulation rather than handouts or subsidies. So I think that's interesting, and that could propel. So that to me is the positive that's offsetting, I think, what's going to become increasingly a drag from tariffs.
You use the word coordination. More people are using the word intervention. You see it as a positive, the potential Intel deal that we've been talking about overnight.
Yeah, so, I think we all forgot. We were talking about sovereign wealth funds before, and we mentioned this last time I was on. So the Department of Defense found $400 million kind of lying around, per se, to invest in MP, which makes, magnets. And they also helped raise $1.1 billion of financing, probably at attractive rates, because of the government's intervention. And that, to me, is the first sort of step towards this kind of idea of a sovereign wealth fund. The Department of Defense only has certain amounts of pockets, so it's going to have to come from other areas. But this is investment, and I like the fact that I've got to admit, full disclosure, I own Intel. I've liked Intel for a while. I think it's going to be a part of what we
No wonder you're
do.
happy based on the last 24 hours.
Yeah, so it's been a good 24 hours for the Chur household. But, I still have to work, but nothing. Having said that, but what I like here is the American taxpayer will prosper, right? If this is the right decision to grow chips, do things like that, American citizens are going to own this share, right? It's not Trump owns it. It's the U.S. citizen. And I think that's an interesting way to do this and let us participate in some of what I think will be this growth around national production for national security. And even then, I'm also making sure, I think I've even simplified it too much, right? Security is good in terms of job security, right? All of a sudden, if you're working at these companies where the government's really focused and that your product is there for national security, you have a more job security. You're feeling more comfortable. I think that lets you spend and behave and be a little bit more enjoyable of life. And those are the things I think that could see the real positive coming out from this sort of thing.
Pete, it's good to see you. Appreciate the take. Peter Cheer there of Academy Securities. What we heard overnight, Lisa, actually more conventional than what we heard at the start of the week with regards to NVIDIA.
We've seen a precedent for this with Ford, with GM, with what the United States did with the auto industry after the financial crisis. We haven't seen just random levies placed on certain key industries in order to sell to certain places. So that's actually more unconventional than this type of more interventionist approach with some key industries in the United States.
We've got a lot to cover this morning, including retail sales. Lisa talked about it. We'll get that data at 8:30 Eastern Time with an update on stories worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump is traveling to Anchorage, Alaska this morning for a face-to-face meeting with Russian President Vladimir Putin. Trump is hoping to broker a ceasefire between Russia and Ukraine, but tamp down expectations ahead of the meeting. He hopes this one could pave the way for a second meeting, potentially including Ukrainian President Zelensky. Meanwhile, traders are paring back Fed rate cut bets. Investors now see about 90% odds the Fed lowers rates at its September meeting. That's down from near certainty before yesterday's hotter than expected PPI data. Markets are looking to U.S. retail sales data due out at 8:30 a.m. Eastern, which, John, you just said. If it shows a strained consumer, it could reinforce the odds of a cut. And as you guys were talking about with Peter, the Trump administration is considering taking a stake in Intel. Sources telling us here at Bloomberg the move could support the expansion of the chip maker's U.S. manufacturing, especially its planned factory hub in Ohio. It comes just days after President Trump met with Intel CEO Lip-Bu and marks the administration's latest intervention in a key industry. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, taking a stake in corporate America.
This is a very unique solution, allows NVIDIA to expand into China. It can make NVIDIA chips the bellwether for Chinese technology, and then the U.S. taxpayer gets a share of that.
The White House would like a share of something else. We'll talk about it next. George Pollack of Signum joins us in just a moment, live from New York City this morning. Good morning. Three days of gains on the S&P 500, just and only just in yesterday's session. This morning, positive once again by just 0.05%. Under surveillance this morning, taking a stake in corporate America.
This is a very unique solution, allows NVIDIA to expand into China. It can make NVIDIA chips the bellwether for Chinese technology, and then the U.S. taxpayer gets a share of that. We could see it in other industries over time. I think, right now, this is unique, but now that we have the model and the beta test, why not expand it?
Well, here's the latest move. Intel shares trading higher in the pre-market. Sources telling us here at Bloomberg that the Trump administration is considering taking a stake in the company. The news coming just days after President Trump met with Intel CEO Lip-Bu at the White House. Joining us now is Bloomberg's Tom McKenzie. Tom, welcome to the program. Can you share with us what you think the strategy is here?
John, on one level, this is an idiosyncratic story about Intel and its struggles around cost-cutting and the challenges and the pressure on the CEO, Lip-Bu, who seems to be back in favour now with the Trump administration. And the other level, of course, and you and Lisa were discussing this with your guest before the break, is this the starting line in terms of an outline around an industrial policy now that's starting to come together for this Trump administration? Clearly, Intel and Ohio and the plans there are in focus for the domestic political piece of this. But the national security story that you and Lisa have been working through is also, of course, central. It's all very well having NVIDIA being able to come out with the designs for the most cutting-edge AI accelerators. But if you're having to turn to Taiwan and TSMC to crunch those out and actually produce them, there's a question mark there. Yes, TSMC is investing in the US market. Those foundries will be there. But if you don't have that super foundry in Ohio, the American play around that production piece, because Intel is end-to-end from design to production, there's a big question mark there for a company that, of course, has already received those subsidies. It also reminds us that this Trump administration is, to some extent, taking a leaf out of China's book to compete and stay ahead of China.
Intel up by 3.6%. Tom, enjoyed your coverage this morning. Thank you, sir. Tom McKenzie out of London. To Tom's point, I think it's such an important point. Tom spent time over in China. He will know that we spent a long, long time waiting for China to look more like the West. And now all of a sudden the West is taking on Chinese characteristics.
Central planning seems to be ruling the day, and we see that in a whole host of different manners. And this raises a question, is this beginning to usher in a new era where that is the status quo, not necessarily the sort of free market capitalism that was accepted maybe 20 years ago?
Well, let's get to that with George Pollack of Signum Global. George, welcome to the program, sir. We know the president's transactional. We know he likes to make a deal. Do you see a coherent industrial policy coming together here?
Yeah, I really do. And thank you for having me on. I think with the president, what you're seeing right now is that American capitalism, at least the version of it that we've had over time, is really leaving people behind, is leaving American voters, especially those more aligned with the MAGA movement, frustrated and feeling that for all their efforts, for all their work, they're not seeing the economic benefits. So the president sees that by being more aggressive with corporations, and especially big tech and bigger corporations, he can get an American government win, for example, up to $7.5 billion from this NVIDIA and AMD deal. And at the same time, he can show the American populace he's taking on these corporations and pushing them to ensure that American jobs are safe, American industry is safe and developing. And I think that's the idea of what the president, that's the idea what his administration is going for.
We've been trying to figure out who's paying for the tariffs, and a lot of people have pointed to companies, and it kind of goes into this conversation of what the new policy is and the sort of interventionist approach. We're seeing significant costs on the part of companies from Ford and GM to Apple when it comes to tariffs, but then they're getting tax cuts. Is this just basically shifting around the chestnuts to see where the ball lands, or is this actually materially shifting the way that companies do business in a way that does generate more growth?
I think that's the question that we ask here today, but I think for the regular American voter, especially the voter who's more sympathetic to the president and more sympathetic to the MAGA movement, they don't see the tariffs as something that exposing to U.S. voters or U.S. buyers. What they see the tariffs as is recalibrating the market in a way that benefits the American economy, that brings home domestic production and shifts the focus from investment overseas to investment within America, which is what the president campaigned on and which is what advisors like Steve Bannon have been so vocal about. So while from a business perspective, it was really just shifting things around and, hiding new places or developing new places to have on the books. But for the typical American voter, especially those aligned with MAGA, this is a great opportunity to push back on countries that have been taking advantage of us.
So hold on a second, George. Are you saying that this is more visual than actual when it comes to shifting things around? I mean, even some of the production in the United States, we've seen companies gussy up plans that they already had put out there, say 2 years ago, when it comes to bringing jobs back to the U.S. I mean, how much is this just simply window dressing versus really a fundamental shift in the approach to business?
I think for the president, this represents a fundamental shift and a fundamental difference in how the American economy and American capitalism operates. Absolutely. And you've seen tech companies, medical companies, pharma companies open lines of investment and foreign direct investment into the U.S. But at the same time, we only have 3.5 more years, of this administration. While that may seem like a long time, for these companies who are deciding on long-term CapEx investments, 3.5 years isn't that long. So I think for now, the way to look at this is as a shift for this administration, but I don't think we can say this is a long-term shift.
George, can we talk about the potential shift politically here in the United States of America? I've always been worried about the pendulum swinging from one extreme to the other. How much time do Republicans have to demonstrate that their approach will work before we see a shift in the electorate to the far left?
I think that's a really good question, but I think the issue is we kind of are having a horseshoe moment in American politics where we're having the far left and the far right kind of united around the idea that big corporations have been taking advantage of America, taking advantage of American voters and focusing investment overseas and not focusing on developing a domestic industrial base, or I guess more so degrading the American industrial base we used to have. So I think, at least from a political perspective, this is part of that long shift. And as we see with the rise of AOC or Mamdani in New York City, I think there's always hope that perhaps we turn back and we go back down the middle of the street. But I think we're seeing a more fundamental shift and a more aggressive shift towards, yes, American capitalism gave us innovation, gave us opportunity, but now American capitalism isn't working for the typical American voter. It isn't giving the voter the American dream.
George, appreciate your take. Thank you, sir. George Pollock there of Signum. Lisa, something you've been talking about now for months and months.
This is the reason why it's unlikely that the tariffs are going to get taken off anytime soon. I mean, yes, he's saying this is only 4 years. How easy is it going to be to undo some of these policies if they're A, bringing revenue into the United States, and B, creating the perception of the United States taking a piece of the pie of the corporate dominance that we've seen over the past number of decades?
Never mind too big to fail, too big to remove. That could be the case in the years to come, that's for sure. Equities at the moment on the S&P 500, just about positive so far. Up next, we'll catch up with Eddie Fishman of Columbia University, with President Trump and Vladimir Putin set to meet face-to-face on American soil. Plus, Danny Berger with your morning movers as a chip maker flashes a warning for China. From New York City, you're watching Bloomberg TV. Heading towards a second week of gains on the S&P 500. Equity futures just about positive this morning by 0.1%. The Nasdaq almost unchanged, down by 0.15. With 3 hours until the opening bell, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Here's one of the tech names that we've been discussing all morning. It is Intel, after that Bloomberg scoop that the government is reportedly in talks to maybe take a stake in the company. Just wanted to note, it rallied more than 7% yesterday, and the rally continues at some pace this morning. We're up by more than 3.5%. That stake perhaps also going to help build out some of their Ohio manufacturing hub. Elsewhere, we got 13F filings overnight. This is when hedge funds and other institutional investors give filings of how much are invested in different companies. Berkshire Hathaway, a $1.6 billion investment in United Health. Always important to note with these that they are backward looking. It's from the second quarter, but this company has been so beleaguered, crisis after crisis. Poor earnings, shares are down nearly 15% year to date, and they rally a whole lot this morning, 12.6%. Finally, we got earnings from Applied Materials after the bell yesterday. It was an ugly one. It was their forecast that disappointed. Shares down almost 15%. The CEO saying, 1, he's getting less orders from Chinese customers. 2, getting approvals for licenses to export their technology to China has been held up and delayed. And 3, the large customers seem to be putting off orders given uncertainty around trade and the economy. John.
Danny, thank you. Appreciate it. More from Danny in the next hour. On our radar this morning, President Donald Trump tempering expectations ahead of talks with Russian President Vladimir Putin as the U.S. pushes for peace in Ukraine. The two leaders set to meet face-to-face in Alaska at 3 p.m. Eastern Time.
A really striking meeting that usually would take months and months of diplomacy ahead of, and a real question of what are the potential deliverables? Is it just a meeting with Zelensky that includes Vladimir Putin? Is there really a renewed prospect of peace? It's interesting that markets are expecting something with respect to easing of relations between Ukraine and Russia. And every analyst we speak to say, we don't see how that could possibly happen, given who has leverage and how different their goals really are.
Do we get the carrot or the stick? How do you sufficiently incentivize President Putin this weekend?
You talk about providing weapons potentially to Ukraine. You talk about economic sanctions. You talk about potential NATO alliance, all things that President Trump maybe isn't going to do. So a real question here, does Vladimir Putin want to get on the same page, given the Russian dream of what one Russia is versus the Ukrainian dream of independence? And that ultimately is just fundamentally at odds, and that's what we keep hearing.
We'll come back to that conversation in just a moment. Our next story, the Trump administration considering taking a stake in Intel. Sources telling us here at Bloomberg a potential deal would help shore up Intel's planned factory hub in Ohio.
You know, Pete Scheer said that this was actually a positive development, and a lot of people would see remnants of what happened in 2009, but in a very different way with the auto sector. There has been a precedent of the United States directly investing in different sectors. There has been the idea of giving them free loans or sort of handouts, as some people would say, in order to incentivize production. This is another approach, taking an actual stake in something. We don't have any details, but a lot of people are hopeful that this actually is taking a page from China's book in some ways to have a more coherent industrial policy and help the United States with domestic chip production.
This industry is super important. We all know that. And if you break it down and just think about what's been developing there for the last decade, last several years, design and build. You've got the fabless model, think NVIDIA, design. You've got the foundry model, think TSMC, build. And then you've got these integrated players that don't know where to go, which is Intel. And there has been talk, action even over the last year, to split off those two things, design, build. Clearly, this administration wants them to focus on building here in the United States of America. It makes a ton of sense to go in this direction. You need government support to make it happen because apparently right now the market isn't supporting it sufficiently.
If the United States wants to be able to do it, it is going to have to take a very long time. And that is what people have realized. And the reason why other companies, maybe rivals of Intel, haven't gotten on the board to create those foundries. They aren't very profitable. They take some 10 years to get up and running. Intel has a head start, so the United States wants to get in on that. And ultimately, a lot of people are rallying behind the shares, hoping that this actually will provide them some upside too.
Up again this morning by 3% in the pre-market. Let's talk about China. The economy slowing down across the board in July. Factory activity, investment, retail sales data, all disappointing, with production of factories and mines rising at the slowest rate since November.
How much is this because of the tariffs? How much is this just structurally? This is an economy that's been in a tough spot, and an administration, the CCMP, not necessarily taking some of the stimulative actions that a lot of people had expected because they were waiting to see what the tariffs and the ramifications were going to be. Real question for markets this morning, does this sort of prod some of the policymakers over in China to inject some real stimulus? Is there going to be government-backed buying of housing, which is one rumor that's been out there? Or is this going to keep them on hold to see how much more pain is coming down the pike from some of these tariffs?
They might have to eat their own overcapacity. I was reading some stories, I'm sure you read the same ones, about the amount of competition domestically now that's leading to price cuts, and margins are starting to suffer. And you're seeing that in domestic Chinese companies. Overcapacity all over the place in that economy.
Yeah, and how do you remedy that? They talked about maybe preventing Chinese automakers from cutting prices too much. How do you sort of engineer this in this perfect way? Markets are a complicated beast that actually are the most efficient way of doing this, and we've seen that again and again. When you try to control it centrally, it gets kind of dicey.
Thank you for saying that. Central planning is not straightforward. Just throwing that out there.
I think that's very fair.
Based on the week we've had so far.
I think that's a wise
It's not straightforward. All right, we'll move on. Let's turn back to our top story. President Trump looking to strike a deal between Russia and Ukraine.
We have a meeting with President Putin. I think it's going to be a good meeting. We're going to see what happens. And I think President Putin will make peace. I think President Zelensky will make peace. We'll see if they can get along. And if they can, it'll be great.
Eddie Fishman of Columbia University writing the following, quote, even small symbolic concessions from Trump could undermine the broader campaign and fracture Allied unity, a scenario that Europe fears. Eddie joins us around the table. Eddie, good morning. Good to see you.
Great to see you too.
I want to throw the question at you that Lisa and I were discussing just moments ago. How do we sufficiently incentivize President Putin this weekend?
I think Putin needs to understand that Trump is actually serious when he says he wants peace. Because I think right now, Putin believes that time is on his side. So he actually sees these negotiations not as an end to peace, but actually as a means to allow himself to continue the war without facing significant pressure. There was momentum building in Washington last week for more sanctions on Russia. Trump himself said that there were going to be very severe sanctions if Putin didn't agree to a ceasefire by last Friday. That date came and went. So Putin already has kind of gotten a victory by delaying that. There's also momentum to provide some more military assistance to Ukraine. So I think Putin, just by getting Trump in the room, by sort of convincing him that he's serious, he knows that Trump wants that Nobel Peace Prize and will stay in that negotiation and prevent real pressure from coming down upon him.
I'd love to know what you think about this framing, because I hear this a lot. President Putin is driven by territorial ambition, not economic prosperity. He does not respond to economic sanctions. How do you change that?
See, I disagree with that fundamentally. He clearly wants to achieve his maximalist objectives, which is to truly annex these 4 territories of Ukraine that he's formally annexed but doesn't yet control. But what happens if the Russian economy is in a massive crisis, right? Even this year, just as we are right now, the Russian economy is in stagflation. They're going to grow probably at most by 1% this year, and they've got inflation well above 10%. So the question is, what if you could get them into a significant recession? And if you had inflation at 20%, which, we saw in the lead up to the nuclear deal with Iran. U.S. sanctions can do this if we actually are willing to go for the jugular, which in the case of Russia is its oil sales.
There's also this question of Russia's leverage, and that has to do with also a nuclear deal that I know has been in the works with the United States, and a question of what happens with their weapons and what happens on an ongoing basis. Do you think that somehow Vladimir Putin has gotten more leverage than people had expected heading into this meeting?
Yeah, I think something to pay very close attention to is that Putin and the Russian media have come into this meeting saying that it's not just about Ukraine. They're also going to talk about cooperation in the Arctic. They may talk about restarting the New START treaty, which Russia stopped participating in 2023, which is this arms control treaty. And of course, they've been talking about these potential economic deals. To me, something that raised my eyebrows is that Scott Bessent apparently is going to be part of the delegation, as well as the Russian finance minister. That's kind of unusual if you're thinking about this as a ceasefire negotiation. And so what Putin seeks to gain there is to really kind of shift the discussion away from Ukraine and persuade Trump that there's a bigger picture here, and that he should actually normalize U.S.-Russian relations irrespective of what happens in Ukraine.
If Trump entertains this idea, how much of a wedge does that put between the United States and Europe?
A huge wedge. And look, I just got back last night from Helsinki. I was there for the past week meeting with various European officials, European diplomats. And they're petrified of this because they know that as soon as there's even a small sign that the U.S. is backing off, let's say Trump agrees to some symbolic sanctions easing, Putin himself is sanctioned. And actually, just a couple days ago, Treasury had to issue a license to allow Putin to travel to Alaska. Let's say Trump says, OK, we're going to give you a little bit of sanctions easing in exchange for some perfunctory Russian concessions. The Europeans are going to be panicked, and they're going to wonder, what can we do to prevent sort of the lid from falling off of this pressure campaign that we have painstakingly built together over the last 3 years?
There has been some criticism of the Europeans in their approach by this administration. Have the Europeans done enough? What have they been doing recently?
Yeah, so I'm glad you asked this because I heard Secretary Besson on the show a couple days ago saying that the Europeans need to step up. Well, just a few weeks ago, the Europeans did the most dramatic sanctions package that I have seen since the beginning of the war. They unilaterally lowered the price cap on Russian oil from $60 a barrel to $47.60. Kind of a strange number. It's 15% below the market price. They did that by themselves. This was supposed to be a G7 decision, but they went ahead and did it themselves. They also imposed secondary sanctions. These are not sanctions on Russia, but actually on Russia's trading partners. They did 2 Chinese banks were sanctioned by the EU. And I think most importantly, they actually sanctioned the second biggest oil refinery in India, Nyara Energy. So they are already directly targeting Chinese and Russian businesses that are in bed with Russia. And that's not something that the U.S. has been willing to do so far.
What's left? What would you like to see happen?
So I would like to see the U.S. join these sanctions with the EU because ultimately, because of the dollar is still the global reserve currency, when the U.S. is on board, the sanctions are much more powerful than if it's just the EU. But there's more that needs to be done. I think sanctioning other Indian refineries, sanctioning Chinese refineries and more banks, and ultimately providing a clear roadmap for how these purchasers of Russian oil, like China and India, can gradually bring down their purchases over time.
You've done an amazing job in your latest book and just generally through your research in understanding how much the global relationships are changing. Depending on what happens in this meeting, how much does that indicate who is against who, whether this is a multipolar world or whether this is everyone go it alone?
Look, I think that there's also maybe a third option here where Trump may be reorienting U.S. relationships toward our historical adversaries. We saw just last week Trump agree to allow NVIDIA and AMD to sell semiconductors to China so long as they pay 15% to the U.S. government. That's a giant concession to China, right? And it's a huge sort of example of how we are warming our relationship with China on this key area of technology competition. If we also start seeing some easing of sanctions on Russia, which I want to be clear, it's not my base case scenario, but it's still possible that it happens today, then you could start saying that Trump actually is kind of pivoting toward Russia and China, and the Europeans are out left in the cold.
Eddie, appreciate your take and your opinion. Thank you, sir. Eddie Fishman there of Columbia University and author of Choke Points. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. China's economy slowed across the board in July with factory activity, investment, and retail sales all disappointing. Production at Chinese factories and mines rose at the slowest rate since November, suggesting President Trump's tariffs are making a sizable impact on that economy. Retail sales also slowed to its slowest growth pace this year. Meanwhile, we are seeing shares of United Health surging more than 12% in the pre-market following news that Warren Buffett's Berkshire Hathaway took a $1.6 billion stake in the company. According to a regulatory filing, Berkshire bought 5 million shares of the health insurer in the last quarter. The same filing shows Buffett sold his entire holding in T-Mobile and trimmed stakes in Apple and Bank of America. And President Trump's tariffs are taking a toll on the chocolate market. Swiss chocolatier Lindt says it may shift production of its famous gold-wrapped Easter bunnies to the U.S. to avoid import tariffs. Sources telling us here at Bloomberg the plan would involve spending as much as $10 million to move production of its hollow chocolate figures from Germany to the U.S. That's your Bloomberg brief. John?
Yahira, thank you. Lisa nodding along as you were telling us that story.
I thought this was fascinating.
I'm partial to a limp bunny myself once a year.
Once a year. This is so you. That is such a you comment. Oh my goodness. But it has to be
I like the
70%.
mini ones.
But do you like milk?
I prefer the mini ones.
Because it's smaller, so you don't have to feel as guilty afterwards.
No, I think they're just, I don't know, there's something about the taste of the flavour profile of a smaller chocolate.
Do you think it'll be a different flavour profile made in New Jersey?
Possibly.
I don't know. We'll see.
Talk more about that another time. Up next on the programme, taking some heat out of rate cut bets.
We think they're meaningfully away from target and even further away in the other direction than they were before the pandemic.
A conversation up next with Veronica Clark of Citi from New York City. This is Bloomberg. Stocks are positive this morning, up by 0.1% on the S&P 500, down about a tenth on the Nasdaq. In the bond market, yields bouncing off multi-month lows at the front end of the curve following PPI. Yields this morning back lower by not even a basis point. The 2-year settling at around 370 at 372.75. Under surveillance this morning, taking some heat out of rate cut bets.
There doesn't need to be a huge pickup in inflation, but the point that we've been making is that even X of the tariff shock, the core PCE, headline PCE, probably stuck around 2.5%. And that's the concern that we have for Fed policy. We think they're meaningfully away from target and even further away in the other direction than they were before the pandemic. We're being hit by so many supply shocks right now that it makes forecasting very difficult.
So here's the latest this morning. Investors walking back Fed rate cut bets with PPI data surging at its fastest rate in some 3 years. Veronica Clark of Citi writing, we expect limited signs of persistent inflation and a weakening labour market will have Fed officials cutting by 25 basis points in September and each meeting after to get to 3%. Veronica joins us now for more. Veronica, good morning.
Good morning.
It's good to see you. That kind of echoes what we heard from Secretary Bessent. Let's get down 150. What is it about the inflation data that you think won't derail this effort?
Yeah, I mean, the July inflation data was interesting. We finally got some firmer data, not downside surprises. And when you dug into the details, yeah, it wasn't actually in goods prices, which obviously people were looking for the signs of that tariff pass-through. It was in services, which sounds concerning, but then you dig a level deeper. And in both CPI and PPI, it's just one-off services that are particularly strong, dental services and CPI. PPI yesterday was portfolio management fees. We know that moves with asset prices. So I don't think there is any sign yet of the broad-based kind of concerning inflation for the Fed.
The key word there is yet.
Yet.
Why won't that change in the months to come?
Yeah, I think the biggest test of the tariff pass-through dynamics is really going to be August and September data. Based on what we know about when tariff rates started to rise, based on, there was in the import price data, some, producers maybe lowered their prices temporarily. We see that in goods like apparel. That's kind of ended though, as people draw down inventories. Maybe it's August, September is that time frame when, okay, maybe you do have to start raising prices. You've held off as long as you can. We know that's when some prices for things like clothing start to rise for a new season. If we still don't see it in those months, if it is more limited, I wonder if that tells us that the consumer really just can't handle these big price increases right now. That is not persistent inflation.
I have Steve Rasciuto of Mizuho in my mind. Stop taking this out and this out to create the number that you actually want, because ultimately, if it comes in hot, if it barks like a dog, it acts like a dog, it wags its tail like a dog, it's a dog. So how much can you really say portfolio management costs? Ignore that. Asset prices don't matter when the wealth effect is real, when you've got retail sales that are expected to come in hot. I mean, how long can you keep being cute about the components?
No, and we don't want to pick and choose. And of course, portfolio management fees were weaker earlier in the year when we had equities falling. But I mean, I think it does speak to, we're not seeing the big broad-based kind of price pressures yet. And I think this is just a very different fundamental demand backdrop than the kind of inflation we saw a couple years ago. So yeah, it's not the ideal number, of course, but there's nothing really blaring red that would stay persistent in this data.
Do you expect any kind of messaging at Jackson Hole that could really indicate how the Fed is going to deal with both the political pressure, but also this data that is open to interpretation?
Yeah, I think we've heard still enough division among Fed officials. There are still, even this week, some officials who are describing the labor market as solid, worried about some of these more persistent inflation risks. So I think Powell does kind of have to walk a line here. You can't be so dovish that we've heard from officials like Waller and whatnot. But I think they have enough information. If they had those revisions, to the July employment report ahead of the July meeting, I think they probably would have been cutting at that meeting. So he'll probably feel a little bit more comfortable guiding towards, we are still expecting cuts, and that could be on the table for the fall.
Is there sufficient two-way risk in the upcoming information? CPI early next month, payrolls the first week of September.
Yeah, we'll learn a lot more. It is that August inflation print that we're going to get before the September meeting. I wonder if we could see some more inflation impact there. It is, I think, the August employment report that matters the most, though.
You and the team seem to be putting a lot of emphasis on employment and that side of the dual mandate. So let's sit on this topic a little bit more. We had Bank of America sat in your seat yesterday, and they're making the case that ultimately what you're seeing right now is not a cyclical turn, it's a structural shift, and that you can have a step down in payrolls growth without an increase in slack. You and the team are taking completely the other side of the debate. So please explain. Tell us why.
Yeah. I think the main debate among everyone watching the labor market data right now is this, some weakening demand underlying this, or is this just an immigration story? We've had a slowing in population growth, and that break-even pace of payroll job growth is lower, I'm sure. But I think in the details of the data, there are a lot of worrying things that this is more than just immigration. This is a weak demand story, and I would look to, a lot of the decline in participation has been discouraged workers. You give up looking for work because you're not finding a job. That's probably not immigration. A big increase in unemployment has come from college-educated workers. Those are probably people not being crowded out by recent immigrants. And then in July, the big increase in unemployment, which, it stayed at that 4.2%, but it was new labor market entrants. That's probably not new immigrants now. That's probably students looking for work and not finding jobs. So there are enough signs that regardless of immigration, there is weakening happening.
I'm just trying to wrap my head around the idea of pegging some sort of Fed move to data that has been undermined in terms of the integrity of it by the U.S. government, where the head of the BLS has just been fired. And there have been such massive revisions that you have a growing number of economists saying that if those numbers had come out in June and July, this Fed would have already been cutting rates. How do you sort of square that circle?
Yeah, there is, of course, a lot of attention, and rightfully so, on the official data. But the revisions, I think, made a lot of sense to a lot of people, me included. We had seen a lot of evidence of weakening labor market before those revisions, and it was payrolls that was the outlier. So it does make some sense, I think. I do trust the official data, of course, just as much as I did a couple months ago, which admittedly is maybe a bit less than 6 years ago. I think the pandemic is still just skewing a lot of this, the data, the seasonal adjustment, some of the collections. It was just a weird data event that happened, and it's going to be weird for a while. But I do trust the official data that we're getting. But you do have to take all the data, form your view on all the data that we have available to us.
So let's get to the data that we're going to get in 90 minutes time. Where do you place retail sales?
Yeah, it is an important one. We've seen this dynamic this year in goods spending where maybe there was some front loading that was boosting sales temporarily. Services spending in the quarterly data and the monthly data have been much softer. Retail sales, I think a couple important things to note, if it is a soft demand story that is limiting the ability of companies to raise prices. Maybe we see that in softer spending. But retail sales are nominal also, so it's important to keep in mind as we're getting into the fall, we could have some bigger price increases, and that could make nominal retail sales when they come out look stronger. But what we really care about, of course, is real spending. I think this number today will be fine, a healthy enough number.
It's good to see you, as always. Thanks for dropping by. Thank you very much. Veronica Clark there of Citi. It's not just the data, really. We're hearing it from certain parts of corporate America, Chipotle, Sweetgreen, McDonald's, I think Carver earlier this week. Next week's a pretty big week for that. I think Home Depot, Target and Walmart on deck.
Yeah, how much they see demand either accelerating or plateauing in response to some of the uncertainty with respect to tariffs. Also, their hiring pictures. I am curious about whether you see a similar trend in some of the retailers that we've seen in some of the tech sector, which has been cutbacks in key areas as a result of certain AI and some of the technological advancements there. So very curious how they're implementing some of those aspects as well.
Sam Rowe out yesterday on X with the reminder of the cheat guide for Walmart. If the numbers are good, the economy's bad. If the numbers are bad, the economy's bad.
Yeah. Okay. Okay, that's what people used to say. I don't think it's that anymore because Walmart is now a broader selection of goods. They now have a lot more high-end goods, and they cater to a larger swath of companies.
Well said. That stock market is a little bit lower this morning. We're down by about 1/10% on the Nasdaq 100. Lots of retailers reporting next week. We'll give you a preview later in the programme. Up next, we'll catch up with Dan Greenhouse of Solis Alternative Asset Management. We'll speak to Ashley Davis of S3 Group, the former White House economic advisor Mark Summerlin, and Ed Al-Hussainy of Columbia Threadneedle. The second hour of Bloomberg Surveillance is up next.
We haven't seen this full pass-through of inflation to consumers. The picture looks a lot better than at least the most recent 3 months.
There's a lot that could still happen on the inflation front that's ahead of us.
Over the coming months in 2025, it could be more volatile, could be more choppy.
The economy, I think, is going to surprise everybody in the next few months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. Your scores look like this. Equity futures on the S&P bouncing by 0.1%, adding to 3 days of gains on the S&P 500 and just about another all-time high at a close in yesterday's session. Coming up later, Lisa's been talking about it. It's 90 minutes away. Retail sales in America, another read on the U.S. consumer.
Yeah, how well are U.S. consumers absorbing some of the goods that have been tariffed, or have they, right? When do we actually get a true read on what consumer sentiment looks like post-tariffs? We've already seen the inflation, consumer inflation, not come in particularly hot. What the inflation that a lot of producers are feeling, though, is can companies keep absorbing those margins, keep absorbing those tariffs on their margins while consumers feel the benefit of it? Or do they start accepting some of these higher prices if those retail sales do come in robustly?
A theme over the last few days talking to you. Just there's some real two-way risk here going into September. It can break either way. So do you want to commit to what you're going to do in September and beyond when you get together at Jackson Hole for an FOMC party in Jackson Hole, Wyoming?
Yeah, the answer is no. I mean, you could say, well, we'll see. I mean, but the answer is, why would you pre-commit to something when you have real two-sided risk and, frankly, you've got a really split committee? More interesting is, how are they measuring things? And actually, President Trump has spotlighted how important data collection is with the BLS. And this is actually key for a Federal Reserve that's examining how the labor market is changing. Is this a secular or structural shift, as you've been talking about in a significant way? Secular or a cyclical shift that we're seeing in some of the data? Does it have to do with immigration? Does it have to do with AI? That is going to be really important to understand how we even count some of this data that some people have thrown some hair on.
It's a lot of doubt, and the market keeps feeding on it. The mount up continues. All-time highs coming into Friday. Equities up again by 0.1%. Coming up this hour, we'll catch up with Dan Greenhouse of Solis Alternative Asset Management as markets inch higher. Ashley Davis of S3 Group as President Trump and Vladimir Putin prepare for their meeting in Alaska. And Fed Chair candidate, the former economic advisor to President George W. Bush, will speak to Mark Summerlin a little bit later this morning. We begin this hour with stocks higher as investors await another round of economic data. Dan Greenhouse of Solis Alternative Asset Management writing, yesterday's PPI number certainly complicates the story, but I still believe the Fed is more likely than not to reduce rates at its September meeting. Dan joins us now for more. Dan, good morning.
Good morning to you guys.
Good to see you, sir. You usually take a constructive view on things. So what's good about things right now?
Well, listen, a lot of things are good right now. The labor market is slowing, but is still holding in there. And I don't think, as Veronica Clark noted at the end of the last hour, that she has not seen, and I don't think most of us have seen, the type of broad-based increase in goods inflation that was predicted 6 months ago when the tariff debate really started. And then on top of that, probably the most important thing from an investor standpoint is just the AI story remains unimpeded right now. The CapEx story, the demand, et cetera, et cetera. And while there's surely going to be an end to all this, from a market standpoint, it's been driving risk assets higher. And again, I haven't seen anything that complicates that story.
Well, let's talk about what we've heard from companies so far on the consumer side, from Sweetgreen, from Chipotle, from McDonald's. Just a bit of pushback here about what's happening. Do you not see that demand side destruction that the Veronica Clarks, the cities of this world, are worried about?
No, I don't see it. I mean, there are obviously isolated pockets. There's some tariff worries. A lot of companies talked about tariffs in the back half of the year being more of an issue than they were in the front half of the year. But I always fall back on my go-to, which is the comments from Visa and MasterCard and Capital One, all of whom said, as of the last earnings report, that things were just fine. And I think it was Visa who said they saw no change in spending patterns across income cohorts. And why that matters is because you can point to Sweetgreen or Chipotle or Tapestry, and these are isolated companies and isolated industries, whereas obviously the card companies have exposure to everybody's spending across sectors, across income cohorts. And so I think they provide they do provide a more holistic view of consumer behavior. And so I take them just a little bit higher, so to speak, in the pecking order than a random retailer.
So we're all chocolate bunnies and cake here this morning and yesterday on Bloomberg Surveillance. And we were talking about, can you have your cake and eat it too? Can you have a resilient consumer while also not having the inflation that would prevent the Fed from being able to materially cut rates? Don't you see a conflict in that picture?
Well, leaving the rates aside, in terms of the resilient consumer, the labor market, again, slowing, but no layoffs, as we see from the weekly jobless claims data, is the best evidence of it. But I think it was Birkenstock yesterday who reported that they passed through price increases in July.
Shocking. How have they got pricing power over there?
Because I'm buying some Birkenstocks for Christmas.
Is that what you're doing?
Yes, absolutely.
Is that what you're actually going to do to me
Absolutely.
later this year?
And I expect you to.
I can assure you,
you should.
as a card-carrying member of the Grateful Dead and Fish community, the Birkenstock demand is unimpeded.
You guys are killing me.
Carry on. I support.
But yeah, so they said, I think it was Birkenstock who said we passed through price increases, and so no pushback whatsoever. And there are a couple of companies that have alluded to that, although, to repeat, numerous companies have said the back half of the year is going to be when these effects are felt. Now, with respect to the Federal Reserve, listen, I think the labor market is clearly weakening. If you look at private payroll growth, for instance, it has slowed down fairly dramatically from, call it, the 6 months before the last one or two. And so when I talk about rate reductions from the economic side of the discussion, I'm not talking about 200 or 300 basis points. There's people running around saying they should cut 100 basis points at the next meeting. I'm not on that train. What I'm saying is things are slowing down. Tariffs are, I can argue, if we have enough time, tariffs are actually deflationary, but that's a separate story. And so if the Fed were to tweak rates lower 1, 2, 3 times between now and early next year or the middle of next year, is that so bad? Is that going to lead to an inflationary spiral from a demand-led standpoint? I don't think so. Now, from an investor standpoint, basically all of what we're talking about is positive for risk assets on balance. That now, again, this is with the caveat that we're going through an economic experiment, the likes of which we have not seen in decades. And so really having a handle on how the risk environment landscape unfolds over the next 6 months, there are a lot of people who speak authoritatively on this. I would push back on every one of them. We have no idea how this is going to happen and unfold. But my working assumption, my expected value standpoint, is that on balance, that this is pretty positive.
Deflationary. You said it now. We've got some time. What makes it deflationary?
Well, you're crimping after-tax incomes. You're curbing demand. To the extent that this is passed through at all, now, again, we have to start from the premise that tariff-led price increases are not inflation. They are a tax. And so if we separate that out, higher taxes on consumers crimp after-tax incomes. And there's more to the conversation, but in a nutshell, that's it. And so I would actually argue, and I've said this a few times on the show, I think by the end of this year, you're going to have the Veronica Clarks of the world, to a lesser degree the Dan Greenhouses, but the economists of the world coming on Bloomberg TV, particularly Surveillance, and saying, sure, PCE is 3.3, sure, CPI is 3.5, but if we X out the tariff categories, and I know you have Steve Rasciuto in your mind saying, can you really X out a bunch of stuff? And we can talk about that, but I imagine people are going to say Xing
Well, at
out
risk of intervening yourself, let's talk about it.
Sure. I'm going to do it in the future.
Why should you just X that stuff out?
Because tariffs are not inflation. And I know that in the context of this conversation, we're measuring them through the prism of inflation, the CPI, the PCE, et cetera. But they're not really, it's a demand-led inflation. It's a tax. And we hearken back to the oil spikes in the 70s. I think this is a good analogy. At the time, oil goes up, inflation goes up, the Fed tightens policy, makes everything worse. We have since learned, that tightening policy in the face of an oil-led price increase, bad idea. And so now you talk about looking through oil price spikes to the extent that they're not demand-led, there's a supply shock, or we bomb a nuclear facility in Iran. I think that the Federal Reserve could probably apply that same rationale to tariffs.
Hold on a second. I wonder if we're thinking about this all wrong.
Probably.
And I wonder if that, because if you look at what's actually happened, companies have absorbed a lot of the tariff ramification on their margins. Ooh, scary. You should say, why are stocks going higher? They should really be reflecting this. Then you look at the other side of the balance sheet, and they're getting tax cuts that almost perfectly offset some of those costs from tariffs. So isn't this just, again, a shell game? Taking things from one to here and there, and then you're not really actually changing anything. So we're kind of making these expectations built on a fiction.
To the extent that I followed what you said, and there was a lot in there, I think, yes, there's a lot of truth in what you just said. I'll leave the academic and the tax argument to the economists. From an investor standpoint, I have to, what's right or what's wrong or a shell game is not my number one concern. My number one concern is what do I do with the cards that are being dealt to me? And in this environment, I think on balance, again, it favors the risk landscape. Now, I'm sure there's people watching going, what is this guy talking about, tariffs or not? Tariffs obviously all else equal, worse than the outcome, worse than the alternative, leaving aside the political goal of what tariffs are trying to engender in terms of a reshoring. You talked about bunnies before. From a risk standpoint, the consumer is still doing fine. The AI story is still doing fine. And so from a risk standpoint, I think that favors, on balance, still higher risk assets. I would add, people keep talking about, is it not reflected in the stock market? This is not a particularly screamingly broad rally. The stock market's up, call it 10% for the year. Only about 200 stocks or so are doing better than that. You'd like to see that number higher. The stock market's at an all-time high. The median stock is down 10, 12% from the high. Very few stocks, 50, 60, are also at all-time highs. So it's not, I would argue, under the surface, a lot of this is being reflected.
So how would this sort of go into a market call? Market weight, equal weight? How much are you looking at small caps? How much are you looking at stocks over credit? What's sort of the risk-adjusted valuation prospect here?
Well, listen, we pick individual stocks, so I'll leave that to the Savita Subramanians of the world to overweight or underweight. We're trying to find companies that do well in this type of environment. We own an emerging market telecom company. We own a couple of oil servicing or waste management type companies with pricing power, with demand, et cetera, et cetera. That's what you're trying to find. In terms of overweighting, underweighting, listen, again, I defer to Savita or Adam Parker or the people that do that more than I do these days. But I'll just fall back on the AI story is still working. And it's not, we know this already, it's not just the NVIDIAs of the world, it's the GE Vernovas and the Eatons, and you can even go down from tier 2 to tier 3, like the Amphanols and the companies that make components that go into the data center racks, et cetera, et cetera. This is affecting broad numbers of the markets. And just to that point, I would add, when you look at the best performers in the S&P year to date, you've got to go down, I forget the number, like 35 stocks in terms of best performers before you find a Mag 7 name in NVIDIA. All the best performing names are, some are AI derivatives, but they are not the Mag 7.
Dan, it's good to see you. Thanks for dropping
Always
by.
my pleasure, guys. Thank you.
That was very easy for me. Appreciate it.
Well,
Dan Greenhouse.
easy for me too.
One
Subway
stop. Management. It's great when he drops by and just interviews himself, right?
And you could say this
if you
you're
give me
talking
time, and I can talk about it later.
Yeah, exactly. Okay, well, have a time. Go
I
ahead.
take the time to watch the segment before me, so I know what I'm
That's
saying.
very good.
I noticed that. Credit to you.
Yeah,
Thank
definitely.
you for that, sir.
You saw that I can't get expressions correct.
There we go. What,
I don't
versus dogs?
Ducks, dogs, they sound similar.
You quack like a duck, you know.
Yeah, but like you bark like a dog.
I didn't bring that up. You brought that.
You wag a dog. Yeah, it actually works perfectly.
It did. I liked it.
Thanks.
It's nice. If you missed that, didn't miss anything. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump is traveling to Anchorage, Alaska this morning for a face-to-face meeting with Russian President Vladimir Putin. It's Putin's first trip to the U.S. since 2015, when he attended the UN General Assembly here in New York. The two leaders will meet at 3 p.m. Eastern, and then delegations from both countries will continue talks. Meanwhile, gold is headed for a weekly loss as traders dialed back their bets on Fed rate cuts at the FOMC September meeting. The slide followed PPI inflation coming in at a 3-year high. The precious metal has climbed by more than a quarter this year, with the bulk of those gains occurring in the first 4 months. And Apple is restoring the blood oxygen tracking feature on its smartwatch in the U.S. following a years-long legal fight. The feature was removed at the end of 2023 due to a patent infringement lawsuit filed by the medical technology company Masimo and a U.S. customs injunction. This hits at a key time for Apple, which is expected to unveil new Apple Watch models next month. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, discussing a ceasefire.
We have a meeting with President Putin. I think it's going to be a good meeting. We're going to see what happens. And I think President Putin will make peace. I think President Zelensky will make peace. We'll see if they can get along.
Ashley Davis of S3 Group joins us next as President Putin touches down on American soil and the President of the United States makes his way to Alaska. Days of gains on the S&P 500, heading towards a second week of gains. Equity futures this morning adding just a little bit more weight to the rally, up by 0.14% so far. Under surveillance this morning, discussing a ceasefire.
We have a meeting with President Putin. I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not. I don't know that it's going to be very important. We're going to see what happens. And I think President Putin will make peace. I think President Zelensky will make peace. We'll see if they can get along.
So here's the latest so far. President Trump and Russian President Vladimir Putin set to meet in Anchorage to discuss ending the war in Ukraine. Putin praising Trump ahead of today's meeting and said he's willing to start work on a new arms control treaty. Bloomberg's Annmarie has the latest on the ground. Morning, Annmarie.
Good morning, John. When it comes to what President Putin wants out of this meeting, it's not even just about what's going on in terms of his invasion of Ukraine. He wants to restart the bilateral cooperation between Washington and Moscow. That's what you just mentioned when it comes to arms control, which that treaty, by the way, the New START, expires February of next year. He also wants to talk about economic cooperation. We are just south of the Arctic Circle, some place where you can, have these critical minerals, potentially cooperation there. And then most notably, obviously, the Russian president is going to be pushing for sanctions relief. And I think it's quite telling who the Kremlin is bringing along. They're bringing along their finance minister, Anton Siluanov, on top of the foreign policy individuals that have really surrounded President Putin for years. And President Trump, just sitting on Air Force One, waiting for the president to arrive, is his team. And alongside the likes of Marco Rubio, who you would, of course, expect to be there, his Secretary of State and National Security Advisor, the president is also bringing along Commerce Secretary Howard Lutnick and Treasury Secretary Scott Bessent. Now, Scott Bessent spoke to you and I this week, Jonathan, and he said that they are prepared for either direction, sanctions relief if the meeting goes well, or to double down on sanctions if the meeting does not go well, really signaling that those secondary tariffs that the administration has put on Russian crude going to India that will kickstart at the end of the month, if there's not an agreement, potentially that could mean this administration is willing to take the step to go to Russia's biggest purchaser, and that's China. So I think it's really telling who is also accompanying these two leaders besides the usual suspects in the foreign policy sphere.
Annmarie, looking forward to your reporting. We'll touch base with Annmarie a little bit later on this morning as Air Force One prepares to take off and head to Alaska in the next hour or so. Joining us now to discuss, Ashley Davis of S3 Group and the former assistant in the Department of Homeland Security. Ashley, welcome to the program. Can you help frame this moment for us? The Russian president touching down on American soil. What's the best we can hope for this weekend?
Well, first of all, I think I need to be on next time with Dan. He seems really fun. And so hopefully we can get together next time. But good morning to everybody. I think this is a huge day for not just the president, but also for people around the world and obviously Ukraine. The number one issue that the president wants to deal with, our president wants to deal with right now, is obviously making sure that people stop dying. This is 3.5 years. This is hundreds of thousands of people that have lost their lives because of this war. There's a lot of rhetoric right now that the president doesn't really know what he's asking for, et cetera, et cetera. I know from my White House days, there is absolutely no way that the conversations between both teams have not been very serious before they would ever let either of their principals join today. I think what we're going to watch is there's probably going to be some sort of announcement with the ceasefire. And then we'll see there is talk that maybe Zelensky actually comes to Alaska and they have a meeting in person there after that. Obviously, I think that is something that would be a fantastic outcome, but probably a little bit riskier. The final thing I want to say is, this is and Annmarie was just saying a little bit earlier, this is not just about the Ukraine war. What the president has done, I think, very well is put the tariffs on Brazil, put the tariffs on India about that actually surround Russia. And so this has come to a point where it's not just about weapons and what we're selling to Ukraine, what Europe's selling to Ukraine, what they're using on behalf of to fight the war against Putin. I think this is really about kind of the economic sanctions that the president really pushed and is limiting them to do.
Is that your interpretation, Ashley, of who is going with President Trump, the Scott Bessents and the Howard Lutnicks, or is it catering to kind of the Vladimir Putin view of this meeting, which is a broader relationship between Russia and the United States that includes the Arctic Circle, that includes arms deals?
I think also critical minerals are going to be absolutely a major part of this. But I actually think if you see the tipping point in these negotiations, and again, we're going to see what happens today. A lot can happen. But the tipping point really happened when our U.S. Senate, number one, wanted to put secondary sanctions on Russia, and we're ready to go. But also how the president did not back down in India, who is an ally of ours, and Brazil and other major countries that buy Russia's oil and gas. And so I actually think the economic tipping point was what really brought everybody together.
So you think that actually the economic pain that Russia is feeling has been enough of a stick so far to bring Vladimir Putin truly to the negotiating table? So right now we're seeing markets price in some easing of the tensions between Russia and Ukraine. You think that this is warranted, it sounds like, based on the lead up to this, who's attending, and the tone so far from both sides. Is that right?
Absolutely. And I'm sure that Russia is getting huge pressure from India, which is one of their biggest, they buy India buys one of the most from oil and gas from Russia. So I'm sure India's like, come on, we've got to get to the table here because you're crushing us. So, whatever you think about President Trump or not, he did put this broader plan together that's trying to squeeze Putin. Obviously, he came into office saying that he was going to stop this war on day one. I think he realized very quickly that he wasn't able to trust President Putin. I lived through the days when George Bush said he could see President Putin's soul through his eyes. I think there's been lots of presidents that thought you could trust this man at the beginning, but you really can't. And so they were able to put this bubble around him, squeezing him, which I think is the economic impact.
Ashley, as you know, and just to build on this thread, President Trump is very willing to take an unconventional approach, to break the status quo, to do things that other politicians won't do. That can be a superpower sometimes. Ashley, I wonder what you think he can do this time that President Biden was unwilling to do. What would you like to see happen here?
Well, and listen, I'm a big believer that you don't criticize what you don't know. And none of us on right now or who's watching were in the room really when the President Biden was having these discussions and his team. But what President Trump did do that Biden did not do, yes, we put sanctions on Russia. Congress put sanctions on Russia. However, they did not do it through this new mechanism, which is the tariffs, which is actually not just impacting Russia, but it's impacting Russia's customers. And so I think, which again goes back to especially India and Brazil. So, and obviously China as well. So I think that is the different mechanism that he used. But listen, he tried to use traditional military and traditional State Department diplomacy to stop it, just like Joe Biden did, and it didn't work.
Ashley, appreciate your time. Dan's no good. Just throwing that out there. All right. He'll have us drinking before 8 o'clock. No good. Ashley Davis.
And
appreciate it. Of SS Group.
Yeah. And making mistakes all around the corner and definitely saying things we shouldn't say. So
potentially. Yeah. You want nothing to do with that. Anyway, look, this is where we are. We're going into the weekend. And if you want some kind of ceasefire, at some point you've got to talk. And this is the opportunity to have that discussion.
Yeah, the range of interpretations really is remarkable. Some people saying it's unclear where the leverage is. Other people saying, like what we just heard from Ashley, that actually all of this noise that we've seen so far with India and Brazil, that people have been attributing to with Brazil, the political backdrop, with India, some questions around their relationship with China. All of these things have been geared into pegging Russia into a corner. I mean, it just sort of shows how difficult it is to really pinpoint what's going on, what's being used as what, and who has the leverage here.
Territorial ambition versus the prospect of better economic prosperity. What's going to drive the Russian president this weekend? Great question at a point when this is something more fundamental to Russian identity than it is necessarily economic growth. Precisely. Up next on the program, we'll catch up with the Fed chair candidate, the former economic advisor to President George W. Bush, Mark Summerlin, plus Danny with your morning movers following disappointing earnings from a major chip maker. Equities firmer by 0.2% on the S&P 500. 3 days of gains coming into Friday. Looking at the prospect of a second week of gains on the S&P. On the Nasdaq 100, just about unchanged this morning. Down by not even a tenth. We're negative 0.1%. 0.04%. Turn to the bond market. 2-year, 10-year, 30-year, just freshening things up in yesterday's session. Multi-month lows on 2-year yields at one point. Delayed reaction to PPI, and then yields started to bounce by 5 or 6 basis points. The 2-year settling down to 372.96. But PPI, just to some extent, maybe a small extent, but to some extent, shaking up that rate cut theory into September.
You saw some of the headline numbers coming at the fastest going back to 2022. So really some really shocking numbers. You look under the hood, though, and people say, one-offs, and they don't go into core PCE, ignore. And guess what? Companies are absorbing it. And it's also the fact that asset prices are high. You put all those things together, people shrugged it off. Today is going to be a real test, though, with retail sales.
Retail sales at 8:30 Eastern Time. Then it's on to Jackson Hole next week. And then after that, early September, a payrolls report. The 5th, I believe. Week after that, CPI. Week after that, you've got the Federal Reserve meeting. 2 hours away from the cash open. Let's deal with the here and now. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. Overnight, we got 13F filings, a peek into the second quarter for what various funds did. These are some of Berkshire Hathaway's picks that we learned from the filings. You can see all of them are rallying, being United Health up nearly 11%. Nucor, Leonard, the home builder, those shares are up 4 1/3%. Got to say, a lot of people buying into United Health. Also, Tepper's firm, as well as Scion Asset Management, that's Michael Burry's firm, buying them. Another pick we got from Michael Burry in the 13Fs was Lululemon, a very unloved share year to date, down almost 50%. So the fact that they piled into that, a new ad for Scion Asset Management, means those shares up 1.8%. Finally, after the bell yesterday, we also got earnings from Applied Materials. It was seen as a very tepid forecast. The CEO saying that large buyers are holding off on purchases, just given a lot of the uncertainty, be it trade, be it the economy, but also noted that China was a real weak spot. For one, China's not buying as much, and they're having a difficult time getting at pace export license agreements to sell out to China. So those shares down 13%, John.
Danny, thank you. Big move there. More from Danny in the next hour. On our radar this morning, the president, the Trump administration in talks with Intel to take the US government's stake in the company. Sources telling us here at Bloomberg that a deal would bolster Intel's US footprint by shoring up plans for a factory hub in Ohio.
And this comes after a pretty tense relationship between President Trump and the new CEO. They had a meeting. This is evidently, reportedly by Bloomberg, what was discussed in that meeting. Regardless of what you think of all the policies, the dramatic shift that we have seen in the United States' approach to key industries cannot be overstated. The fact that we're seeing it on multiple prongs, this is the latest that actually is more traditional in terms of taking a page out of an industrial type of policy where you invest directly in companies akin to what we saw in 2009 to resurrect GM and Ford. What I think is notable this time, it's not coming on the heels of crisis. It's coming on the heels of an anticipation of a structural shift going forward and national security concerns.
National security, precisely. And sometimes the free market won't support your national security ambitions, and you have to step in. This is what ultimately they're trying to do here with Intel. Get them to domestically produce things that other companies won't be willing to, even with massive tariffs.
Right now, the idea of being a foundry, the idea of producing chips is something that doesn't make money, that takes a long time for a long while. And this is the reason why the government is sort of understanding Intel's point. If the government wants them to be a foundry, a developer, a chip builder, they need to provide some of the resources, and that seems to be what's on the table.
Stock is up again this morning by 1.7% in the pre-market. Here's the latest on India. The Indian Prime Minister, Narendra Modi, denouncing US tariff policy, saying in a speech that global economic selfishness is increasing day by day. Modi urging citizens to strive for self-sufficiency after the US imposed a 50% tariff on the country.
So we haven't seen the retaliatory tariffs that a lot of people had expected, but we do see an increasing shift, at least in rhetoric, around the world to global self-sufficiency. We're just talking about the United States as sort of key sectors to be self-sufficient in. How much has this become an increasing national security call around the world as at a time when you can understand the economic warfare that can be waged? I just wonder, longer standing, how much this does shift domestic policies around the world and sort of the fracturing of some of the trade lines. This, to me, is actually really interesting.
I find that phrase interesting, economic selfishness. What about economic hypocrisy? Have you ever seen the tariffs on some of the goods going into India? On phones, on autos. On autos, the last time I looked, I think we're looking like 60, 70% and up for certain autos.
Consistency isn't necessarily what a lot of people are looking for. I agree with you. I think that you could make this argument in a lot of ways, which is the reason why you even heard Europeans come around to say leveling the playing field when it came to negotiating tariffs with the United States. Clearly, Modi is taking a different point. Part of this was a very political speech, though, so he's catering to a population. So there is definitely a very political undertone to everything that he said, even with respect to immigration from Bangladesh, with respect to the relationship with Pakistan. But going forward, I just think it's going to be really interesting to see how some of these countries pivot to more domestic types of industrial policy as well in order to protect themselves against this type of incursion.
Everybody's got their own domestic concerns. That's the latest on India and Narendra Modi. Here's the latest on the Federal Reserve. Presidents Tom Barkin and Alberto Mussolem signalled major policy reductions might not be warranted. Barkin saying underlying consumer dynamics feel healthy. Mussolem saying a 50 basis point rate cut might not be supported by economic conditions.
So St. Louis Fed President Mussolem saying he just isn't necessarily sure which way things are going to break, not necessarily going to the 50 basis points, reiterating what we heard from Mary Daly. Tom Barkin was actually more interesting to me because really it spotlights the retail sales that we're going to get in about 55 minutes time. The idea, if you get robust retail sales, is that a reason for the Fed not to cut rates? Suddenly, are we looking at different data points to try to give those tea leaves ahead of this monumental speech next week, which will be in Jackson Hole, discussing and maybe giving a sense of what's to come in the fall?
I'm not sure if the whole decision on September should hinge on one data point, and that data point being retail sales, but we'll find out, I guess, in 54 minutes.
Come on, help me drum it up. I mean,
Okay.
It's August. Let's
I'm
go.
beating the drum.
Thank you.
8:30 Eastern time for US retail sales. It's an important data point. It's one of the few ones we have left going into the September meeting. Let's stick with the Federal Reserve. President Donald Trump narrowing his choices to replace Fed Chair Jay Powell to 3 or 4 names, saying he'll announce his nominee a little earlier than initially expected. Joining us now is the former economic advisor to President George W. Bush, Mark Summerlin. Mark, of course, your name has been in the mix as well over the past week or so. Welcome to the programme. Let's just start with the base case, the case for rate reductions, Mark. What do you think the strongest case is right now?
Right. I think the strongest, first of all, thank you very much for having me. I think the strongest case is we just have to mark to market to the new data that we have. The data was revised very strongly to the downside on the jobs, and that's the most important data that we have. And so it's, jobs for May and June only came in at 33,000 combined for those 2 months. And so had we gotten those in real time, it's likely that the Fed would have cut probably in June and July. And we know that the economy barely grew over 1% in the first half of the year. And so a 4.33% Fed funds rate is just too high for the economy that we have right now.
Mark, can we stay on that payrolls data? Because there's been this great debate on Wall Street, and I have to say it's very divided at the moment. Do you think that step down in payrolls growth, and clearly you do, you think it speaks to a cyclical turn and not a structural shift? But can you tell us why you believe that's the case? What the distinction is between one versus the other?
Absolutely. I do think it's cyclical. I mean, I think if you step back, like very big picture macro, we have fiscal tightening this year from the tariffs. Next year, we're going to have some fiscal loosening from the tax bill. And behind all of that, we have the AI productivity gains starting to take hold for the first time. And so it's a pretty mixed, confusing macro picture. But you got to kind of ride it out in real time. And so we just know, like, before the data revision, there was a disconnect between jobs and GDP. And then after the revision, there was no disconnect. Jobs got revised down to reflect what was going on elsewhere in the economy. And it's really important to mark to market to where we are and not just to say, oh, well, whatever we had before is still fine for the Fed funds rate.
So let's do some scenario analysis. Let's say you become the next Fed chair. Congratulations. And let's say in September you cut by 50 basis points on the heels of some of this jobs data. And then you see 10-year yields shoot higher, akin to what we saw last year when the Fed cut significantly. What do you do?
Yeah, then you stop. And so one of the reasons I support the 50 basis point cut right now is that you have the inversion in the front end of the curve that's something like 60 basis points last time I looked. And so you know that you can cut by that amount without really upsetting things. But the weakest part of the market or the economy right now is housing. And so you can't have the long end go up. And that's your constraint right now. And so if the long end starts to go up on you, you have to stop cutting. It's that simple.
You could make the argument that if the market, if sort of this collective decision-making body truly believed that the economy was significantly weakening, the 10-year would be significantly lower. Doesn't that sort of indicate that there is enough strength to continue at this sort of pace with these rates? I mean, isn't that some sort of signal in and of itself?
I think if we go back to January, a lot of people, a lot of the best bond traders on the planet thought the 10-year was going to be at 5 or over. And so the fact that we're at 4.29 instead of 5 is a reflection of the weaker economy in my mind. So these things are always judgment calls, but I think right now you have the scope to cut by 50 basis points, and then after that you'd have to look at the data and you'd have to look at the markets and you have to look at what's going on in the real economy and put it all together.
Mark, I'd love to know if you can share with us what your approach would be if you had the honour of taking over the top job at the Federal Reserve. We heard from the Treasury Secretary, who was sitting around the table with us just a few days ago on this programme, and he talked about the need for foundational change at the institution.
Yeah.
What do you think needs to change?
Yeah, first of all, I think that the staff is all set up wrong. To do the job correctly, you have to understand three things. There's the data and there's the economic modeling side, and all of the staff, basically, that's what they do. And then you have financial markets. You need to understand what's going on in high yield spreads, what's going on in oil markets, what's going on in bond markets. And then you have what's happening in companies. And especially right now, at a time of so much change, you really need to understand what's going on with AI and productivity gains in companies. And so I would like to have the staff completely change where a third of it is doing economic modeling type of stuff, and then a third of it is real sectoral experts. The Fed chairman should have someone who is an expert in autos, an expert in retail sales, an expert in every single thing in-house, so that you really have the pace and the feel of the economy going on, as well as more market people there that understand, okay, high yields spreads are blowing out, and this is why we need to worry, why we don't need to worry. And so for me, it's less of a, I don't have a problem with the size of the staff because I think, the Fed is so mission critical to the whole world. I just think there's just so much redundancy. And right now it basically functions as like a university research department. And I don't know why that's the case.
Mark, this actually raises a point that John's been talking about significantly, which is how much does that mean a more active Fed when it comes to balance sheet management? And it's not just quantitative easing, but also just the denominations of where you buy. If you treat this more like a markets operation than a university, how much more active does that balance sheet become?
Yeah, that's a good question. And I think that the balance sheet is an important tool when you need it. So definitely in crisis, it's something that's in the toolbox and it works. I don't think it works that well or needs to be continued after the crisis is over. And so, if we were coming out of the pandemic or something, I would have definitely ended the QE sooner rather than later. But there are important questions right now when we have very high mortgage spreads about why are we still selling off MBS when we have 150 basis point spreads that are hitting the housing market right now. So I think you just have to look at it very objectively about what's the impact of the balance sheet in the real time. And there's some people who would love to go back to the old days when there was no balance sheet. And I think that's a fine argument if we could rewind time back to 1995. It's just very hard to go from where we are now to that type of operation.
Mark, this was a very thoughtful conversation, and hopefully we can continue it over the next few months. Thank you, sir. Mark Summerlin there, the former economic advisor to President George W. Bush. Some credible ideas in a mix from Mark just then.
Very much so. In particular, his comments on the long end of the yield curve. If you cut by 50 basis points and suddenly you get a spike higher in the 10-year yield, well, then stop cutting rates. It's not necessarily to manipulate the entire world and start buying 10-year treasuries. This is something I think the markets could probably rally behind.
And no spike this morning, 429.26 on a 10-year yield. From New York, let's get you an update on stories elsewhere with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. The Trump administration is considering taking a stake In Intel, sources telling us here at Bloomberg the move could support expansion of the chip maker's domestic manufacturing, especially its planned factory hub in Ohio. The plan comes just days after President Trump met with Intel CEO Lip-Bu at the White House. Meanwhile, Goldman Sachs is offering clients a stake in Millennium Management for a minimum commitment of $1 million and as much as $20 million. Millennium is seeking buyers for a 10 to 15% equity stake at a valuation of about $14 billion, according to documents circulated by the bank. Millennium's hedge fund has made 10% or more in all but 9 years since 1990. And New York City officials announced the death of a fourth person in connection to an outbreak of Legionnaire's disease in Harlem. 99 people have been sickened and 17 have been hospitalized since late last month. Health officials say you can get the disease by breathing in water vapor that has Legionella bacteria, which grows in warm water. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next, paring back rate cut bets.
I didn't tell the Fed what to do, perhaps because they had bad BLS data in June and July, that perhaps a 50 basis point cut in September was warranted.
Is it warranted? We'll catch up with Ed Al-Hussainy of Columbia Threadneedle from New York. This is Bloomberg. Beautiful pictures incoming from Joint Base Andrews of Air Force One just before it takes off and departs to Anchorage, Alaska. Just getting confirmation that the motorcade has left the White House. The president is on his way, making his way to Joint Base Andrews. One post from the president so far this morning, 2 words, high stakes. Put that out on social media in the last hour or so.
A lot of people would agree, given the fact that ultimately this is the first time, I believe, that Vladimir Putin has been on U.S. soil since 2015. And potentially this could set the groundwork for some sort of further agreement between Ukraine and Russia.
We'll keep tracking that story throughout this morning, tracking the markets as well. Equity futures positive here by 0.2% on the S&P, unchanged on the Nasdaq. In the bond market, yields bouncing yesterday, just unwinding some of that heat in the rate cut bets. Yields back to about 370, 317 at the front end of the curve. Under surveillance this morning, paring back interest rate cut bets.
I didn't tell the Fed what to do. What I said was that to get to a neutral rate on interest, that would be approximately 150 basis point cut. I did not call for them to get there. The other thing that I said was that perhaps because they had bad BLS data in June and July, that perhaps a 50 basis point cut in September was warranted.
Perhaps. Here's the latest. Traders dialing back expectations for a September rate cut after fresh wholesale inflation data signaled tariffs are pushing prices higher. Ed Al-Hussainy of Columbia Threadneedle writing, if the Fed determines that it will look through higher inflation in the second half of the year, employment risks dominate and the case for front-loaded cuts is ready to go. Ed joins us now for more. Ed, good morning. Do you think the case for front-loaded cuts is ready to go right now?
Not quite. Well, as the president said, it's high stakes. There's a lot of pressure, I think, on near-term labor market data to validate the view that unemployment is on a trajectory higher. And I think we don't quite have that data yet.
At this point, do you think that if they were to cut by 25 or 50 basis points next month, you could see an unmooring of inflation expectations around the margins? Or do you agree with some of the recent commentators, including Mark Summerlin, that probably the market would be contained as they're already pricing that in?
It's really tough to say. I mean, I think if you look back over the course of the past 12 months, inflation pricing is a little bit on the high side right now. It's consistent with some of the price pressure we've seen come through in the inflation data over the course of the past quarter. Is it going to run away if the Fed cuts 25 basis points? Absolutely no. I think that is well in the price at this stage. Now, if the Fed signals a much more aggressive easing cycle ahead of us into data that's strengthening, I think that's the risk case. That's an environment in which inflation expectations run away and investors and tips are going to be quite happy.
That really sets up the data that we're going to be getting in about 38 minutes' time. How much is it important to see a retail sales number that actually is contained or not as strong as people previously thought, to not be a 1-2 punch from yesterday's PPI data, that there isn't this sense that there is enough consumer demand to keep some of those pricing pressures there, and even some of these companies from passing along those price increases to consumers?
Yeah, I mean, it's an incredibly difficult question. It's clear that consumer demand slowed in the first half of the year relative to where we were last year. The next couple of retail sales prints, are they that critical? Probably no. I don't want to take the joy out of waiting for this print over the next 60 minutes.
Come on, work with us, Ed.
Look, every data point here is important because we're trying to feel out, and your previous guest pointed this out, there's a little bit of a disconnect between what's going on in the demand side of the economy and inflation. And inflation has continued to run a little bit uncomfortably hot. There's some price action in services in particular that is not really consistent with demand slowing significantly. And I think we're going to have to close that disconnect in the second half of the year for the Fed to have the comfort to cut more aggressively.
Ed, let's build on some of this. Equity markets are at all-time highs. Credit spreads are back to about 280 on high yield. That doesn't scream there's a problem in this economy. Now, is that a reflection of what's actually happening in the economy, or a reflection of the rate cuts people expect to support the economy? Which one is it?
Well, I think it's less the rate cut story at this stage. The market's not pricing in an aggressive easing cycle. The market's pricing in rates drifting towards normal, about 125 basis points, over the next 18 months or so. That's not very aggressive. That is consistent with the economy normalizing. What does that do for spreads? I think not that much. To me, the underlying story on the credit side is one of balance sheet health. And on the equity side is really extraordinary expectations for returns on some of the technology like AI, and margins continuing to come in relatively healthy, despite a lot of noise in the background in the first half of the year. I think those are all forward-looking expectations. You can take a look at where risk is priced right now, and I think reasonably conclude it's relatively rich. And again, that is a conversation that's slightly separate from the problem the Fed has to deal with on inflation and employment.
Ed, we miss you. Hopefully we'll see you in New York in the studio next time. Ed Al-Hussainy there.
Absolutely.
Columbia Threadneedle. Thank you, sir. Appreciate it. You talked about margins at the end there with regards to the equity market. I actually think one of the standout lines that came from the Treasury Secretary, Scott Bessent, in our conversation with him earlier this week was actually on margins. I've got it in front of me. I'll read some of the language to you. There were some margins that got very fat during COVID, and now we're seeing a return to pre-COVID margins. It's quite a statement about what's happening with tariffs, what isn't happening with consumer prices, but what is happening with margins.
And it follows what we're hearing from the companies themselves, how much of a tariff-related cost they're going to bear on their bottom line that they're not passing along in price increases. We've heard that from the auto manufacturers. We've heard that from some consumer brands. I'm thinking of e.l.f. Beauty, for example. This works with their messaging. I just wonder how realistic it is going forward if there is ongoing consumer demand, whether companies will keep eating it because they kind of like those margins that they got during the pandemic. So there's that push to actually increase prices, and we're seeing that in some of the commentary.
We're also seeing this right now, the motorcade arriving at Joint Base Andrews as the president heads towards Air Force One to depart to Anchorage, Alaska. 2 words from the president about his meeting, a face-to-face conversation with the Russian President Vladimir Putin and the President of the United States. The President calling it high stakes. More on that conversation next hour.
The steady grind, this buy the dip, this no questioning the price action.
It's certainly a time when you want to really think about your sector exposure.
There's a bit more weakness and rotation and churn happening under the surface.
It feels like a melt-up already.
What we're looking at here is a really, really solid earnings backdrop for the S&P 500 that we think persists in the back half of the year and has legs to run into 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now. The opening bell about 90 minutes away, 30 minutes away from some economic data. This weekend dominated by this story, a face-to-face conversation between the President of the United States and the Russian President Vladimir Putin. Moments ago, the President of the United States boarding Air Force One, making his way to Anchorage, Alaska.
Yeah, Annmarie reporting that he waved and gets on the plane on Air Force One without commenting to media. Media very much anticipating where the stakes really are right now. Who has the leverage heading into a meeting where the parameters are fairly wide? The president seems to want to get a meeting where Volodymyr Zelensky joins them, maybe even in Alaska. That's a best case scenario. Vladimir Putin has very different goals with maybe a more wide-ranging economic agreement between Russia and the United States.
Look at who's on board this plane with the President of the United States. You expect Senator Rubio to be there. He's there. Secretary Besson, Secretary Lutnick. Look, this is going to be a conversation that's more than just about foreign policy. It's going to be about economics.
There's a lot of potential ways to interpret this, and we've heard people on this show interpret it in different ways. One of them could be discussing sanctions on places like Brazil, on places like India, some of the clientele of Russia. How much is that going to be part of the conversation? There's another way of interpreting this, too, which is the carrot that President Trump could be offering also as a part of this could include some sort of new economic arrangement between U.S. and Russia.
We'll keep tracking that story for you throughout the weekend. Annmarie's on the ground. We'll catch up with her in about 50 minutes' time, so look out for that. Mentioned retail sales a few times, 8:30 Eastern time for that next data point. Just a week away from Chairman Powell delivering his speech at Jackson Hole.
Yeah, and you keep raising this point, and it's a really important point. How much information do they really have to be able to make any conclusive shifts in economic policy, monetary policy, given some of the different interpretations, I should just say, of the data? Yesterday, we got PPI data, producer prices that came in significantly hotter than expected. People shrugged it off and said, oh, it's market prices that have been inflated. Oh, it's just a couple of other inputs that aren't necessarily put into core PCE. Nonetheless, do you see a hot retail sales print as potentially giving a sense of just how much momentum there is in the underlying economy? Tom Barkin actually came out and indicated that was something he'd be watching. So I think it actually does have importance, regardless of what Ed Al-Hussainy had to say.
Yes, you tell him.
Yeah,
the data's 27 minutes away.
It's important.
It's important. Equity futures right now in the S&P positive by 0.1%. Coming up this hour, we'll catch up with Emily Bowersock-Hill of Bowersock Capital Partners as stocks look for a fourth day of gains. Luke Tilley of Wilmington Trust reacting to the latest US retail sales data, and Binky Chadha at Deutsche Bank on whether market moves are justified or quite simply overly optimistic. We begin this hour with Stock Steady ahead of the latest read on the US consumer. Emily Bowersock-Hill of Bowersock Capital writing, until the tariff impacts begin to show more in the inflation data or in consumer demand, the market's upward trend is likely to continue. Emily joins us now for more. Emily, good morning.
Good morning.
It's great to see you in person. Let's talk about the data so far. What's it telling you about where we are, and what's your judgment about where we'll be in the months to come?
I think the PPI data that came out this week was concerning. And I think what that shows us is that inflation is coursing through the economy now, even if consumers have not felt it yet. So this has put the Fed into a tough spot, obviously, and we've seen the chances of a 50 basis point rate cut drop pretty substantially. I am seeing more and more parallels to the 1970s, and people have been talking about that quite a bit, but the parallels are growing. And at that time, we had an external supply shock, which previously differentiated this period from the 70s. But now we also have an external supply shock. A trade war is a supply shock. And so, this is not the trade embargo of 73 or the Iranian Revolution, but that's the backdrop. Then we have a president who's placing enormous pressure on the Fed chair. Same thing happened with Arthur Burns, and Arthur Burns, as we all know, finally caved, and it did not end well. And the third thing is that Nixon took the U.S. off the gold standard in 1972, and that forced the dollar down. And we're seeing a similar decline in the dollar, which, as we all know, is inflationary to U.S. consumers. So I'm becoming increasingly concerned, and I think probably the Fed board members and the chair are as well. They don't want to make that mistake, that same mistake.
I'm not sure how you said all that without saying stagflation.
Oh, well,
but
yes.
You did, so let's talk about it.
They don't want to make the same mistake and end up with stagflation.
Is stagflation good for stocks?
The smell of stagflation is increasing. Let's just put it that way.
Is that good for markets at all-time highs right now?
Stagflation is a very bad scenario for markets generally. And so it's not something that anyone wants. And quite frankly, the market at this point, while it has very substantial upward momentum, I would argue that a substantial part of that upward momentum is coming from retail traders. Retail trading volume now often reaches about 25% of volume. 5 to 10 years ago, that was 12%, right? And so on the 3rd of April, for example, that first week, we saw $4.7 billion of purchases by retail traders in the market. And what ended up happening was that professional traders and money managers really had no choice but to jump on board, given all of that forward momentum. And many of these retail traders, feel free to push back because there is some evidence for this, but I would argue that a substantial percentage of those retail traders skew male and younger. And I think people are allowing their political and cultural beliefs to drive their investment decisions far more than they were 5 to 10 years ago.
I'll leave that there. I'm not going to push back or go further with it. But it does raise a question that if you believe that the economic circumstances are vastly different to some of the price action, why are you still constructive?
I'm constructive because I think this momentum is real. And I think that, frankly, again, there's a substantial contingent in the market that wasn't there 5 years ago that's putting a floor. It's the buy the dip mentality that is, I think, quite embedded. Now, it will take some significantly bad news to derail the kind of momentum that we're seeing. And we could get that in the retail numbers. I think it will disappoint the market if we don't see a rate cut in September. But I think the market is certainly overvalued, but there still are pockets of value there.
So you said it would be disappointing to the market if we don't get a rate cut, meaning that a bad retail sales number would be a good retail sales number that would indicate some sort of momentum or purchasing, right? I mean, that's sort of the indication there. I am just curious to dig into this whole idea of sustained inflation and PPI being really negative. Some people have said, well, companies are absorbing it. This is something even Scott Bessent told John and Annmarie, that this is actually a normalization of margins for a lot of corporations, and we have seen them eat it without passing it along to consumers. How does it change? How does it pivot to going into consumer prices in a more sustained way if these companies seem to be indicating that they're more concerned about maintaining market share than they are about maintaining their profit margins?
Well, we always thought that the tariff impact on inflation was going to be a 3Q and a 4Q story. But either the tariffs are going to shrink margins, which is not good for the markets, or it's going to end up in consumer prices. And quite frankly, it's probably going to be a little bit of both. So, and when I say that there's strong momentum behind the market, I'm not saying we're not going to have a typical seasonal correction of 5 to 10%. I just mean that there's in my opinion, a floor under the market. One of the things that I keep saying to clients, because clients ask me, how is it possible that the market is still going up when we just passed this tax legislation, which is going to add trillions of dollars to the national debt? We have a tax on the rule of law. We've got the firing of the commissioner for the Bureau of Labor Statistics, and they'll list these negatives. The market doesn't care about what's going to happen over 3 to 5 years. The market is a powerful discounting mechanism that goes out, that's looking out 6 to 9 months. And on the 6 to 9 months basis, the news is generally good. Earnings were positive. There was a very low bar, but this legislation is probably going to add about 0.5% per growth. AI, the boost to productivity, is real, and it's masking a lot of these underlying issues. That doesn't mean that there aren't some fundamental problems being created that we're going to see beyond the time frame that the market is discounting.
There are economic risks and there are market risks, and if you look at the biggest weights on the S&P 500 and track their earnings have been tremendous for the likes of Microsoft and others.
Yeah, you're talking about the AI story, the overlay that makes it very difficult to make some sort of macro call on a U.S. market that is much more secularly driven at this point.
Record highs again this morning, up 0.1%. Emily, good to see you.
Good to see you too.
Thank you for dropping by the studio. Thank you. Emily Bowersock-Hill there of Bowersock Capital Partners with an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump is en route to Anchorage, Alaska for a meeting with Russian President Vladimir Putin. Among those accompanying Trump are Secretary of State Marco Rubio, as well as Commerce Secretary Howard Lutnick and Treasury Secretary Scott Bessent. Trump and Putin are set to meet at 3:30 p.m. Eastern, and the two may hold a press conference after the meeting. Meanwhile, shares of United Health are surging 10% in the pre-market following news that Warren Buffett's Berkshire Hathaway, among others, took a $1.6 billion stake in the company. According to a regulatory filing, Berkshire bought 5 million shares of the health insurer in the last quarter. And Tropical Storm Erin could soon become the first hurricane of the Atlantic season. Erin strengthened into a tropical storm overnight and is expected to continue gaining strength over the next few days. The storm could become a Category 4 hurricane by Sunday, and thankfully it is forecast to stay away from the U.S. We shall see. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, the morning calls, plus Lorraine Hutchinson of Bank of America with retail sales just around the corner. That data drops in about 20 minutes' time. From New York City this morning, good morning.
I think the economy is slower than people think. We're seeing pockets of inflation. So I feel there's pressure on the consumer. I think the global economy is slowing, right? Everyone's trying to figure out what to do with tariffs. And, we're all trying to look for these signs of tariffs. I think we're still in the early first inning on tariffs, right? We've only just seen them come in place. It's going to take months, if not quarters, maybe a full year before the impacts are fully felt. But I think you're starting to see those signs.
Peter Shea of Academy Securities looking for more signs of some kind of economic impact from policy over the last few months. Retail sales 15 minutes away. Here's the stage. This is how it's set. Your scores look like this. Equity futures at the moment positive by 0.1% on the S&P, down 0.1 on the Nasdaq. Muted price action there. In the bond market, 2-year, 10-year, 30-year shaping up as follows. At the front end of the curve, bouncing off multi-month lows at the front end yesterday following PPI. Yields this morning just about unchanged. The 2-year 372.75. That's the price action. Here are your morning calls. First up, HSBC downgrading Cisco to hold, seeing strength in AI, offsetting weakness elsewhere. Your second call from Stifel, cutting its price target on Applied Materials to 180, citing the company's weaker than expected Q4 outlook. And finally, Bank of America downgrading target to underperform, pointing to margin risk due to slowing digital sales growth. Sticking with the consumer, U.S. retail sales just around the corner with the potential impact of tariffs very much in focus. Bloomberg's Mike McKee has more. Good morning, Mike.
Good morning, John. Well, Lisa asked a key question a little bit ago when she said, where's the bad news? The markets are waiting for bad news because it would be good news for them if the Fed cuts interest rates. Today, we don't know. Retail sales are the headline number this morning, and they're not expected to be changed on a headline level. 0.6% gain, same as last month. Retail sales control maybe tick down a little bit. That's where you take out gasoline, home building supplies, and automobiles. And that's supposed to go down just a little bit, but it would still imply a decent month in the month of July. The biggest wild card in July is that it was Prime Days month for Amazon and Walmart and Target and a lot of big retailers who cut prices, and retail sales are measured in dollar sales. So we're going to have to take a look at that. The other big number this morning to look at is import prices, not so much the headline, which is also expected to be unchanged, but ex-petroleum, take out oil prices. And did we see prices go down? If prices went down, it's a suggestion that maybe some of the exporters are taking some of the hit to their products from the tariffs in the United States. If export prices stay the same or go up, it would be the other case. So there's a lot to look at here. And one thing I might mention is that you also asked the question of whether we are seeing any kind of impacts yet, or whether they're still to come. Barclays out with a note that says one of the reasons prices have not risen because of tariffs is because so many products are exempt from tariffs, especially stuff coming in from Canada and Mexico, and because companies are shifting supply chains and getting things from lower tariff countries. We'll see if that plays out.
Mike McKee, looking forward to your breakdown in about 13 minutes' time. Not sure where Mike is now. Is he making his way to Jackson already?
I think he's probably already wearing his hat and riding on horses.
He's on his way a week early.
I think he's riding on a horse there to really understand the Western way.
OK. He was talking about tariff inventory and pre-tariff inventory. Gene Soroka, we talked about this yesterday together. It's been a roller coaster ride all year long. Ride's not over yet. The data coming out of the port of Los Angeles, seeing the highest container volume in its 117-year history just last month. Just how much pre-tariff inventory are we working through here?
Yeah, just adding to the complications, you have pre-tariff inventory, the fact that people hoarded goods ahead of expected tariffs, which led to pretty big pops in terms of some of the import numbers that we've seen over the past few months. But then there also are all of these agreements that are still in place with some of the contractors that have kept prices from rising as much as they otherwise would. You add all this soup together, it's very hard to come up with any kind of conclusion.
Super complex stuff. Let's stick on the story. Lorraine Hutchinson of Bank of America looking ahead to retail earnings kicking off next week, writing this: after a volatile quarter, we expect off prices to post sales growth at or above guidance. Lorraine joins us now for more. Lorraine, welcome to the programme. I'm sure you were following that quick conversation there. We'd love to get your thoughts on how some of these companies have been managing their inventory over the past few months.
Sure. Good morning. Many of them have really started to take a real stake in inventory ahead of the tariffs to try to de-risk themselves as the tariffs hit and changed. And we think that that has really helped the margin picture, certainly for the back-to-school selling season. I would say one of the most interesting data points I've seen for back-to-school was our proprietary BAC credit and debit card data showed that sales in the last couple of weeks of July really started to surge. And that's interesting because that's given on a dollar basis, so that would include any price increases that came in July. And it implies that the back-to-school selling season is actually off to a pretty strong start. So if you're looking at my retailers in particular, when do they want to really perform well? It's those last couple of weeks of July when people are first going out and trying to buy their back-to-school items. Where they don't want to outperform is later in the season when everything goes on clearance. So I think we're seeing some initial signs of strength after a pretty rough May and June.
What can we interpret from that, Lorraine? Is this that a lot of companies are offering really good discounts, like Mike was just talking about with Amazon Prime and Walmart Prime and all these special days? Or is this really just a robust demand backdrop that's going to sustain some of this momentum heading into the fall?
Yeah, I mean, I would say it's two things. First is when the consumer is feeling a little bit stretched, they tend to event shop. So they really need back-to-school products, they'll go buy those. They may not buy things that are discretionary or sort of off the cuff, but they will buy during events. Second thing is we're seeing particular strength from the off-price retailers. So that tells us that consumers are really looking for value. So maybe other areas of their budget are rising in price. Where they need to save money is on the more discretionary pieces like apparel and accessories, and they're using retailers like TJ Maxx, Ross Stores, Burlington as a way to get better value for their dollar.
One thing that Scott Besson told John and Annmarie this week was that a lot of profit margins are just normalizing at companies and that there was this sort of pop in the post-pandemic period that now is coming in. Do you expect this to be the new normal, that companies, to the extent that there are any tariff ramifications, will just eat them on their bottom line and not pass them along to consumers?
You know, I think it's a difficult game to play if you're a retailer because the consumer has a lot of choices. So historically, apparel prices have been deflationary as consumers trade down and find better value. I think for some brands with high heat, with higher price points, dealing with wealthier customers, we do think that they will be able to raise prices on a modest basis to offset tariffs. I'm a little more worried about the lower end retailers where the consumer's already stretched. It's going to be hard for them to pass that through. And in some cases, they may need to take some of the margin.
Lorraine Hutchinson there of Bank of America. I think we might have lost the connection with her just then. So we can build on some of this. I'm unsure if this falls under her coverage, but ultimately McDonald's, Sweetgreen, Chipotle have cautioned on some weakness with the consumer over the past few weeks. Don't know if we'll see that retail sales at 8:30 Eastern time. But ultimately, we might see it with the retailers next week.
Yeah, and how smart have the retailers gotten in terms of catering to some of the lower income consumers by offering discounts, et cetera? And then to Mike's point, how does that show up? Let's say the number of sales has increased, but the total volume, the total dollar price hasn't necessarily as much. A lot of factors to look in. But if you take a step back, and we've heard this from Bank of America, and we heard this from Aditya Bahave earlier this week, it has been resilient. You see credit card operators continue to say spending is there and it is across the income spectrum. So at what point do you see the weakness that would really justify some of the rate cuts that people are looking for?
Not seeing too many signs of that just yet. Mike McKee's still with us. Mike, we just wanted confirmation. Where in the world are you? And have you already made your way to Jackson Hole?
I am in Jackson, Wyoming ahead of time. There is another conference ahead of the Fed conference that we'll be covering for you on Monday. And we're looking forward to that. And also doing a story for Wall Street Week you'll watch next Friday on Jackson, the town and its economy.
Looking forward to that, Mike. Before you go, Lisa's been talking about retail sales all morning.
Oh, yeah.
Typically, we talk about CPI and then payrolls being a big factor in the decision this Federal Reserve's got to make. Is this a missing piece of the puzzle for this Federal Reserve? Just how important is it?
It's a small missing piece for the Fed. It's probably a little bit more so for the markets because they need to react to something. But the Fed knows that these numbers are heavily revised. We'll take a look at what we got in June after today's revision as well. So it may not be as decisive as some of the others, especially the CPI and the jobs report.
Mike McKee, looking forward to your breakdown. Mike McKee is going to be with us in about 7 minutes' time. Already made his way to Jackson Hole, Wyoming, as we break down the retail sales data for you and look ahead to that speech from the chairman of the Federal Reserve, which most people always anticipate to be the sort of preamble to what we might see from the Federal Reserve itself more broadly in the following month.
The shorter it is, this is just sort of the cheat sheet, the shorter it is, the more shocking it'll be. That's been our experience. Remember the Payne speech? We were expecting him to go on for 45 minutes, 8 minutes. That's it. There will be Payne. And then he exited the stage, and that really created a big market reaction. Does he have the same sort of conviction this time around, given that I'm trying to make retail sales great again, and that we really don't have the data to really support any kind of conviction whatsoever?
We all remember the Payne speech well. We were both there.
Yes.
And then there wasn't any.
Correct.
Do you remember that?
Yes, I do.
And then last year they were worried about the labour market. Turned out to be a head fake. This is the debate for me right now. It's actually not so much on inflation and this tariff pass-through. It's about what's happening with this labour market. We've clearly had a step down in payrolls. We can all see it in the data. We've seen the revisions. Then we're all agreeing on what we can see the numbers ourselves. What does it mean? That's where there's real debate, real divided debate on Wall Street.
And there's an additional debate that the Fed has to have, which is what is their approach at a time where there's so many different ways to take the economic story? I'm still thinking about what Mark Summerlin said, to basically treat the Fed policy as something more of market timing or a hedge fund or something like that, where you're gauging all the different instruments and getting a sense of what the market is telling you. The bond market speaks. Listen to it. I mean, at a certain point, how much is that the road forward if there is a lack of clarity on the economic side?
The data speaks. In about 5 minutes' time, U.S. retail sales, the latest read on the U.S. consumer coming up. Mike McKee will break down the data. We'll catch up with Luke Tilley of Wilmington Trust from New York City. Retail sales, 5 minutes away. Economic data moments away, about 20 seconds away. Retail sales just around the corner. Mike McKee's going to break that down for you. Your scores an hour away from the opening bell are shaping up as follows. Positive 0.1% on the S&P, down about 0.1 on the Nasdaq. Basically where we've been all morning. Bit snoozy this Friday morning. That could change in a few seconds' time. In the bond market, just look at the front end of the curve. Yields bouncing yesterday, coming back down by a single basis point this morning. 3.72. With that economic data, let's cross over to Mike McKee. Good morning, Mike.
0% Well, it looks like we've got a reasonably good but slightly disappointing retail sales number. Headline number comes in at 0.5%. Last month was 0.6 unrevised, and the forecast was for 0.6. For autos, ex-autos, we're at 0.3, which is what was forecast. That's down from an unrevised 0.5 last month. The control group that everybody cares about, of course, is up 0.5, same as last month. That would be good news. It shows Americans are still out there spending. Of course, I'm saying good news, and the markets probably aren't liking it. Import prices up 0.4%, and ex-petroleum up 0.3. That would suggest one thing: importers are not bearing the brunt of Trump's tariffs, Trump's import taxes. They are actually keeping prices steady and not cutting them. One other number out, the Empire manufacturing number increases to 11.9 from 5.5. And I'm sorry to take up too much time, but I got to give you the revisions here on retail sales just out. In June, 0.9, up from 0.6. So you add that to the 0.5, and we have had a pretty strong summer for consumers. For the control group, 0.8 instead of the initially reported 0.5 in June. So another 0.5 there. And Americans are still spending money. The tariffs have not stopped them. And this is not going to be a sign that the Fed is anxious to cut interest rates.
Mike McKee, thank you, sir. It certainly won't change the debate too much, but we're seeing some muted price action off the back of it. Yields back up to about 4.30 on 10s now, up a single basis point, almost 2 basis points higher on the session. At the front end of the curve, down about a basis point, now up about a basis point. So let's call it 3.74 on 2s. In equities, not much movement off the back of this. Still positive on the day by 0.1%. But again, it's a little bit more information. Just another data point that suggests there shouldn't be a rush to reduce interest rates by 50 basis points.
Yeah, just removing the possibility of a 50 basis point rate cut a little bit more in market expectations. And I emphasize a little bit more when you look at Fed funds futures right now, almost fully pricing for a 25 basis point cut next month. It seems like there is a coalescing around the idea that the economy is robust, but there is concern around the labor market. The Fed could probably afford to shift down. This definitely speaks to the robust side of the picture.
Tracking two stories simultaneously at the moment. One is the economic data. At the same time, the president is on Air Force One talking to reporters, and our team's breaking the headlines for us as he speaks. This stood out for me on the talks set to take place between him and the Russian leader in Anchorage, Alaska, that Ukraine wants to negotiate. And the following headline: the territorial swaps will be discussed.
This was something that originally we had heard wouldn't be discussed, that they wouldn't really discuss which land would go where, because ultimately that had to be something that Ukraine discussed. But this, coming from President Trump, that he may provide security guarantees to Ukraine with the European Union, not NATO. So maybe a way to get around the red line that Vladimir Putin has put out there about NATO membership for Ukraine. Either way, it seems like there are things being discussed that maybe people weren't expecting to be discussed in this particular meeting.
So this is the setup then for the next 30 minutes or so. We'll come back to that story in just a moment. Anne-Marie's in Anchorage, Alaska already. We'll get her thoughts on this story in about 15 minutes from now. I want to turn back to the data. Mike McKee just broke it down. Mike, I know you've just had a second read of things. What jumps out for you now?
Well, we've had a sort of bounce back in some categories. Motor vehicles and parts dropped down a little bit to 1.6%, but that was better than anticipated. Furniture and home stores, 1.4%. That's down from 5.1%. But then we have had a better month for clothing and clothing accessories. It looks like back to school got started early, up 0.7%. Sporting goods up 0.8. General merchandise stores up 0.4. The only thing that really drops is miscellaneous retailers are down 1.7%, and food services and drinking places down 0.4. Now that's a kind of a contingent category of retail sales that shows whether or not people have some disposable income, but they were spending in other places. Gasoline prices were up only 0.7. They were down 2.9%. So that's one reason that we see a rebound in overall sales.
Mike McKee. Thank you, sir. Michael McKee breaking that data down for you. Luke Tilley joins us now of Wilmington Trust. Luke, welcome back to the programme, sir. I understand you're looking for rates in September, October, December. What supports that view at the moment?
Yeah, I think that what we've seen is essentially a weakening of the consumer and also a slowdown in CapEx. Probably more important than that is that inflation is incredibly tame over the past 6 months. Core CPI has basically been at the Fed's target. And I really think it comes down to the fact that the tariffs are driving up the prices of goods, but you're getting a lot weaker spending. So as we look through this morning's numbers on retail sales, which I agree are quite positive, the most important thing here is that they are nominal and they also are just spending on goods. So to the extent that tariffs are driving up the prices of these goods, the more important numbers that we're going to get in a couple of weeks is when we see these deflated in the PCE numbers, but also see how spending on services is going. Because our position all year has been, as you get these price increases on tariffs and it's going to drive up the nominal value of retail sales to some degree, you're going to see weaker spending on services. That's what we've seen all year, and I think that's what we'll continue to see, and that leads to those Fed decisions in part.
Luke, you put the same data in front of 5 different people and you get 5 different opinions. We've heard that all morning. Some people saying that what we just saw actually suggests a really robust backdrop. Other people like yourself saying this is just reflecting the inflation that you're seeing out there. What data could you see before the next Fed meeting that would make you change your mind, that would focus you more on the strength side than the weakness?
Yeah, well, I'm an economist, so if you get 5 of us in a room, you're going to get at least 8 different opinions. But I'm going to stick with mine on this, which is that we need to see what I was talking about, that PCE spending report at the end of the month, because that will have this same spending on goods data, but it's going to be deflated for all of the inflation effects. And then also the spending on services and in real terms. So on a month-to-month basis, these things can be very volatile, and obviously the markets are going to move with that. But let's take a step back and let's take a look at the broader economy over a longer time period, and also what the Fed is looking at. For this year, consumer spending slowed in real terms from 3% at the end of last year. It's been cut in half to about 1.5% annualized for the first 6 months. And I think we're going to continue to see that slowdown. Consumers are facing those higher tariffs on goods, so they've been cutting back on services spending. And we're also going to continue to see, I think, slower jobs data, and that is also going to lead to slower spending. And that is the broader picture that we need to look at. So I agree that this morning's retail sales numbers are positive, but they don't paint the entire picture. When we look at the entire picture, we see a slowing economy with very little inflation pressure. And that brings us to the conclusion that the Fed is likely to be cutting rates.
We've been asking this question, and John was asking it yesterday. Can you have your cake and eat it too? Is this something that the Fed can offset with rate cuts and allow the economy to keep chugging along, which seems to be what people are pricing in across all instruments?
Yeah, I think so, because we don't really have a fundamental problem with the economy right now. It's not like you've got massively overvalued housing or a tech bubble or something like that. You had an economy that was clicking along last year. It's been hit with a fairly substantial tax hike in the form of tariffs. And more importantly, that changes the cost structure for companies. So that comes at a time where you're just going to get basically a little bit of a slowdown and a stumble for the economy as firms adjust both to the higher tariffs and then also to some of that uncertainty. So we see the economy flattening out here in the second half of the year, but there's nothing really fundamentally wrong that's going to drive it into a deep downturn. But it's enough that it should have the Federal Reserve cutting rates. You don't need restrictive rates when the economy is so slow. And then, as I said before, you don't have inflation pressure. When we look at inflation, especially if you look at the CPI and just exclude that pesky shelter component that's drifting down, the CPI ex shelter has been below the Fed's target for almost 2 years now. Consumers are not out there spending in a way that's going to drive up prices. And to the extent they've been hit by tariffs, they're just going to take away on the services side. So we don't have an inflation problem. And if you've got unemployment rate near neutral, if you've got inflation near neutral, well, then rates should be right around neutral.
Luke, I want to pick up on the language you're using because you're a very deliberate, purposeful guy. You keep talking about neutral and restrictive, and I think this is important. Getting down to 3, if you believe 3 is neutral, means that you can cut 150 without really talking about getting accommodative. Now, Luke, I don't think that's too controversial, but what do you think the range of neutral is on the committee at the moment? And how close will we be to a much bigger debate further down the road?
I think the neutral is pretty close to what we think it is. We think 275 to 3%. The committee is right around there, but it's obviously up for debate and it could be changing. I think the more important question is how quickly do you get there? The Fed and everybody on that committee knows that their movements have a lot of power and their words have a lot of power. So they would want to be communicating, getting to that point on a slower basis. And we know that their communications can have just as big of an impact on rates and financial conditions. When they started to hike in the beginning of, I guess, 2023, they had already been talking up rates for 3 or 4 months ahead of that. They had already doubled the 2-year yield well ahead of that first hike. And they can do that on the downside, too, without actually dropping rates by 100, 150 basis points. They can just start pointing towards it, and it would ease financial conditions in the same way without being a real shock to markets.
Luke, appreciate your time. Luke Tilley there of Wilmington Trust, looking for rate cuts in September, October, December, then again at the first 3 meetings in 26.
You know, I wonder, as I was listening to him talk, I'm like, well, he could be a Fed candidate, too, because I'm sure that a lot of what he just said would appeal to the administration. Right now, it seems like people are seeing the inflation prints as disinflationary or not necessarily indicating some sort of longer term shift. I keep going back to what Steve Rasciuto said. Excluding certain items, how long can we do that before we're sort of ignoring some of the inflationary pressures that at least the headline numbers seem to be suggesting?
Steve is living in your head rent-free, isn't he, at the moment?
Well, I just think that it's so different from what everybody else is saying.
I agree with you.
I actually value a sort of contrarian take, and I think it's worth thinking about.
I'm enjoying the debate at the moment, how divided things actually are.
Well, it's a reason why I wonder if economics is so divided, is taking a market-based approach the more effective way of going about it? I mean, honestly, this is sort of the level of rethink that is going on right now.
I just don't think it's that controversial, this call for 150 basis points from the administration. Now, maybe you think it's controversial that it's coming from the Treasury Secretary, but you've just heard it there. Most people's opinion of neutral at the moment is 3. Maybe you think it's climbing, I don't know, but most people believe it's 3. And if you believe we're not in a position where we need to be restrictive anymore, then starting that journey back towards 3 might make sense. Now, I say that as I sit here and say I still think the jury's out on the data, and you've got to wait a number of months to see which way this breaks. But I don't think there's too much daylight between some of the things I'm hearing at the moment when people say 150 and then they sort of throw their hands up and they're running to be the Fed chair. I don't think they are. The Fed in their forecast has got 3 as the long-term neutral dot, right?
The political pressure has muddied the very real economic debate that is happening, and that is happening with a lot of intellectual rigor in a lot of places. And I think that that is really the core of what you're getting at, which is this is a real debate. And I think that the politics of it has sort of shaded it in another tone.
I agree. The market open just around the corner. We are positive by 1/10% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Here's a recap of the latest economic data. Retail sales came in slightly below estimates, rising 0.5% versus expectations of 0.6%. Still, it's a sign consumers keep spending despite price increases. They stepped up their spending on cars and took advantage of online promotions, with the likes of Amazon and Walmart having major sales. Meanwhile, we've been talking about this story all morning. The Trump administration is considering taking a stake in Intel. Sources telling us here at Bloomberg a deal would help shore up Intel's planned factory hub in Ohio, which has been repeatedly delayed. It comes a week after President Trump had called for the ouster of the chipmaker's CEO, Lip Bhutan, and then they had a meeting at the White House. And we end on some good news. Mortgage rates are ticking lower for a 4th straight week and are at their lowest level since October. According to data from Freddie Mac, the average rate for a 30-year fixed loan was 6.58% last week. Long-term rates haven't been below 6% since September 2022, and it looks like we have a ways to go. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. Have a good weekend. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Binky Chowdhury at Deutsche Bank on the pass-through for tariffs and the equity market. And we'll catch up with Annmarie in Anchorage, Alaska on a face-to-face meeting over the weekend between Putin and Trump.
One of the reasons I support the 50 basis point cut right now is that you have the inversion in the front end of the curve that's something like 60 basis points last time I looked. And so you know that you can cut by that amount without really upsetting things. Right now you have the scope to cut by 50 basis points. And then after that, you'd have to look at the data and you'd have to look at the markets and you have to look at what's going on in the real economy and put it all together.
That was the former economic advisor to President Bush. That was Mark Summerlin. He's also in the running to become the next Fed chair, looking for a 50 basis point reduction at the next Fed meeting. The data so far, okay. Retail sales about 20 minutes ago, no drama there. Equity futures just about positive on the S&P 500, still just about negative on the Nasdaq. No drama at the index level with some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. The biggest loser in the S&P 500 pre-market, Applied Materials, down 13%. Earnings yesterday, a tepid forecast, all about weaker sales to China, slower getting licenses to export to China, and large customers pulling back given the uncertainty. All those comments from the CEO. Elsewhere, Roblox, the video game maker, also falling quite heavily in the pre-market trade, down 7% late yesterday. The Louisiana state attorney opening up a lawsuit against them, saying that they've created an environment for exploiting children. TD Cowen writing a note reaffirming their sell rating, showing it just highlights the regulatory risk around this company that has mostly young users and user-driven content on it. Finally, rounding things out with Intel, the rally from yesterday, more than 7%, continues at pace this morning, up about 3% after that excellent Bloomberg scoop that the government is in talks to potentially take a stake in Intel. All of that would help build out an Ohio hub. John.
Danny, thank you. Thanks for this morning. Danny Berger there with your movers going into the opening bell. Let's stay on the market. Binky Chana at Deutsche Bank writing the following. It is clear from company comments that tariffs were a sizable headwind, only for some. And the hit was modest and significantly lower than previously feared, although it is likely to grow. Binky joins us now for more. Binky, good morning.
Good morning.
It's good to see you. How are things going to rebalance in the months to come?
I think, where we are, I think a very simple way of thinking about where the S&P 500 is that we, of course, had basically the very, very robust 2023 and 2024 returns. And if you look at it, and if you will pardon me for using slightly technical expression, S&P 500, was for those 2 years and really starting a little earlier in a very, very steep trend channel. We were, in round numbers, 24% years. That's, 24% a year. That's 2% a month. It's a very, very robust channel. Of course, Liberation Day threw us way, way out of that channel. And we have now recovered basically to the bottom of that channel by the first week of July. And really for the last 6 or 7 weeks, we are crawling along the bottom. So, bigger picture, if you think about it, we fell because of the tariffs. We had this big sell-off, and we've now recovered. So the question is, is it justified or is it just optimism? But that long drawn-out chart that I just drew for you is just to sort of focus the mind that actually what the market's saying is that, we had the tariffs. We all expected them to have, pretty big negative impacts. It's not evident in the growth data. It's not evident in the inflation data. Aggregate earnings for the S&P 500 in the second quarter, growth actually accelerated. So it's got the wrong sign in terms of the negative impacts.
So is there a less technical way of saying this, which is that in some ways profit margins are normalizing? What Scott Bessent was saying to John and Annmarie this week, that in a sense, this is more normal. You might not get the 24% returns every year, but you'll be able to adjust and adapt, move forward with something that's a solid gain, but not necessarily out of the water.
Yeah, so again, I would say, in terms of the margin issue, the cost accounting way of thinking about margins is fine, but does it really actually hold up? For the S&P 500 as a whole, margins actually went up, and margins are at new high. So, I understand the nice intuitive narrative. It's just, it's not in the facts.
Is it difficult to gel what the economists are saying at the moment to sort of put that together with what you see in earnings?
I think, the economist position is pretty reasonable. If you think about basically, their calls for inflation, take our house view. We see basically, the direct impact of the tariffs as about 2 percentage points on core goods prices. And then there's the indirect impact, as everything feeds on each other. And that's, I would argue, the larger standard error to try to estimate as and when and how much. But if you focus for a second on the direct impacts, I would argue if you look at core goods prices, we already had half the pass-through that we were looking for. So, if you're negative and bearish, you can wait for the second half is going to tip us over into something or the other. But on the face of it, why should it be any different than the first half? And in fact, it might be even a little bit slower. And we think it might be a little bit slower because if you listen to companies, raising pricing is basically the last resort, so to speak, number one. Number two, the directly impacted companies are about 17%, less than 20% of S&P 500 earnings. 5 percentage points of that is Apple. And they did talk about tariffs, but there's lots of other things going on. They just dominated basically the impact. So
I think this is another way of saying the economy is not the S&P 500. Is that fair enough?
I think a lot of people have said that again and again, but I think that that's the conclusion that we have to draw.
Another reminder this morning from Binky Chandler at Deutsche Bank. Binky, it's good to see you.
Good to see you.
I know you're taking 2 weeks off for your birthday too, so happy birthday.
Thank
Enjoy
you.
your vacation.
And congratulations.
Nothing ever happens in August. And then things happen in August, I know, repeatedly. Something's happening this weekend in Anchorage, Alaska. The President of the United States in a face-to-face meeting on American soil with the Russian leader, Vladimir Putin. On the ground, Annmarie. Annmarie, just moments ago, some headlines breaking from Air Force One about the president's approach to these talks.
Yeah, Jonathan, I think two things really stand out as the president briefed reporters on his way to Alaska. One is that territorial swaps will be discussed, but President Trump is not going to be the one to make the decision on that. He said Ukraine will be the one to make the decision on that. He is here to bring everyone to the table. Second, the president said that Vladimir Putin is bringing over with him a lot of businessmen. So I am wondering who exactly is the president talking about? But the president made clear there will be no U.S., Russia business deals or cooperation until this war is wound down, until there's a cessation of hostilities and a peace agreement. I think those two statements from the president are really important going into this meeting he has this afternoon with President Putin.
Annmarie, looking forward to your reporting. Thank you. The latest there from Annmarie on the president's approach to these talks from Friday and potentially through the weekend.
Right now, the market seems to be geared up for some sort of easing in tensions between Russia and Ukraine. A lot of daylight between what's going on right now and getting to a place at the end of this weekend where that momentum can get sustained. A lot of people hoping that this conflict can stop given the human life that's been at stake.
Have you got the cowboy hat ready for next week?
Oh, yeah.
Lighter note.
Chaps, everything. I'm going.
Ready to go?
Yeah, exactly. I'm going to go to the rodeo.
Boots.
Exactly. I'm incredibly excited. My long underwear for sitting outside. For
Look after TK.
Yeah, I will. Don't worry.
Got some babysitting to do next week.
It'll be fun.
Enjoy that. Now, looking forward to the coverage, guys. Really am. Jackson Hole next week. Big lineup on Monday. Steve Chevron of Federated Hermes, Neil Dutter of Renmac, Jack Manley of JP Morgan, Claudia Sam of New Century Advisors, and a whole lot more. Have a great weekend, guys. From New York City this morning. Good morning. This was Bloomberg Surveillance.
Day 8 at the Cincinnati Open. 2023 champion Coco Gauff eased into the quarterfinals with a comfortable victory over Lucia Bronzetti. Coco will face another Italian, Jasmine Paolini, for a spot in the semis. And don't forget, you can watch all the action live daily on Tennis Channel.